Good morning, everybody. I'm Mark Mazur, the Robert C. Posen Director of the Urban Brookings Tax Policy Center. It's my pleasure to welcome you here today for another event where we partner with the University of North Carolina Tax Center to bring different perspectives to bear on important tax issues. Today's topic is the effects of corporate and business provisions of the Tax Cuts and Jobs Act. And while the act overhauled the U.S. tax system about a year and a half ago, we're still trying to understand and figure out all the implications. And today will be another step on that journey. One of the most effective ways to understand complex legislation and the impacts it can have on the economy is to bring people together from different backgrounds and represent different professions to examine things and see what insights emerge from that. The UNC Tax Center has been using this approach for years, and we're glad to partner with them and see if we can build on these successes. We have a stellar set of scholars here today, representatives of accounting, economics, and law, and I expect we'll all learn a lot about the Tax Cuts and Jobs Act, how it's being implemented, what the likely implications are for domestic and multinational firms. This is the third Tax Policy Center event we've had in the new Urban Institute conference space. We're really happy to have this great public space. We know it's a big step up from our previous location. We're still working out some of the details and some of the kinks, so if you see stuff that's not working or if you think could work better, please let us know. We'll try to address that. I'd be remiss if I didn't mention one of our colleagues, Ed Outsley, is not here with us today. Ed was an accounting professor at Michigan State University, was a friend and collaborator to many of us. Unfortunately, Ed passed away last month in East Lansing. And I know I speak for many of us when I note the sadness I feel. I look into the audience and see an empty chair where Ed would have been. But I know we have a strong program today, one that Ed would be proud of. So let me switch gears just a bit and go over some of the logistics for today. We're going to have two panel discussions with a short break between. There'll be time for questions toward the end of each of the discussions. Microphones will be provided in the audience, so when you have a question, raise your hand, be acknowledged, and pick up a microphone so everybody can hear the conversation. Want to welcome the audience who's watching online, and as well as the people who are here in person. I encourage you all to participate in the discussion via social media using the hashtag #LiveAtUrban. And while we hope for a vibrant discussion both here in person and online, and so your contributions there will help make that a reality. And now it's my pleasure to introduce Professor Ed Maydew from the UNC Tax Center, who will make some opening remarks. Ed, welcome to the podium.
Good morning, everyone. So my name is Ed Maydew. I'm the director of the UNC Tax Center, and we're delighted to have you here today. I want to echo the remarks about Ed Outsley. I'm not going to add on to those because I would probably choke up, but no one wants to see that. But we're delighted to have you here today. We've collaborated on an all-star panel, essentially, of people from accounting, economics, and law. That's the idea behind the UNC Tax Center, is to bring people together with diverse opinions that share a common interest in tax. And we've got people from both academics and industry and what have you. So we're looking forward to this, and I'll just turn it over to the first panel. Okay.
Good morning, everyone. I'm Courtney Edwards. I'm a clinical associate professor of accounting at the University of North Carolina. I'm also assistant director of the UNC Tax Center. And I want to, again, thank TPC for partnering with us again this year. We really appreciate the opportunity to be here with a diverse audience and be able to explore all things tax with you. So thank you so much for being here, and thank you, TPC, for your partnership. So I want to first introduce the folks that are up here on the stage with me, so you can know who you're going to be hearing from today, and then I'll let them introduce themselves a little more fully and describe their research in just a moment. So first we have Ben Page, Senior Fellow at the Tax Policy Center, followed by Jeff Hoops, who's Assistant Professor of Accounting at UNC. and followed by Dan Lynch, Assistant Professor of Accounting and Information Systems at the University of Wisconsin School of Business. So again, I'll let them share a little bit more about themselves and their research in just a minute. As we heard from Mark, and as probably everybody in this room, I hope, knows or realizes, or maybe they're in the wrong room, but tax reform passed into law a little over a year and a half ago, and the purpose of this first panel is to talk about the preliminary effects of that reform on the economy and on businesses' behavior, as far as we know at this point. So short-term effects at this point. Reform was passed in a very compressed time frame, and again, I know a lot of you know what reform did. I'm hoping a lot of my students are out there watching as well, so just as a brief reminder, we had a pretty enormous cut in the corporate tax rate down to 21%. Immediate expensing was enacted, at least temporarily. We have income that had been previously untaxed inside foreign subs, immediately subject to tax at a lower rate. As a transition to a pseudo-territorial system for foreign earnings where dividends to U.S. corporations would no longer be subject to tax, and then sprinkle in that mix a couple of anti-abuse provisions intended to discourage diverting profits into foreign jurisdictions. So a lot was going on in that reform bill or in the act that affected businesses. So with that, I'm going to pass it on to Ben and the rest of our panelists to share what they know so far.
So I specialize in the macroeconomic effects of fiscal policy. And so that's what I'm going to talk about kind of at a very general level. How did the Tax Cuts and Jobs Act affect the economy? And my bottom line is that you can think about the short-run effects and longer-run effects. The short-run effects in 2018, to me, seem pretty consistent with what was expected, a little bit of a boost to the economy. The longer-run effects, I think the bottom line is it's too soon to tell. There's not a whole lot of evidence for big positive effects yet, but time will tell. So I mentioned kind of what we expected to happen. So this is a graph of various analysts' forecasts of the impact of the Tax Cuts and Jobs Act on GDP. And I'm first going to talk about the blue bars. Those are the effects for 2018. So you can see that there was a fairly good consensus across different analysts that there would be small positive effects, modest, in the range of a few tenths of a percentage points on GDP. And when you look at the evidence when I look at what happened in 2018, it seems fairly consistent with that. There was a little bit of a blip in the quarterly pattern, so that we came in with a low growth in GDP in the fourth quarter of 2018, and then higher than expected in the first quarter of 2019. If you smooth those out, basically the growth in 2018, I think, is very consistent with the predictions for that analysts made when the act was passed. And these short-run effects are essentially, they're, I think, one of the areas where we understand the economy best, the macroeconomy. If you give people money, they tend to spend some of it. If people spend money, that tends to boost the economy. And that's exactly what we saw in 2018, or the evidence is consistent with that. So I think that's not so surprising. The big divergence in estimates are in the orange bars. Those were the predictions on the level of GDP in 2027. And they range from negative effects to 3% positive effect on GDP. And so have we seen anything yet that would help us evaluate which of those predictions look the most likely to happen? Well, the main difference in those long-run predictions had to do with investment and the capital stock. The positive predictions were that there would be big increases in the capital stock, wages would be higher, and those increases in the capital stock would be due to basically increased incentives for investment in the tax code, lower taxes on the returns to capital. Whereas the low predictions were that, well, this tax bill's boosted the deficit, that's going to soak up a lot of savings and offset the effect of incentives on investment. So what have we seen so far? So the dotted line is, when a bill is passed, if you look, there has been a modest increase in investment as a share of GDP, a few tenths of percentage point. And that's actually not it looks small in the graph. It's actually pretty substantial. If that were maintained, that would boost GDP by maybe a percentage point in 2027. So kind of at the high end of the kind of central tendency of estimates. The real question is, will that be maintained? Is that, where did that come from? Will it be maintained? So there was a recent paper released by the IMF that says, well, this increase in investment is about what you would expect just from the Keynesian effects, just from the short run effects. So there's an accelerator effect on investment. What investment tends to rise with expected growth rate of GDP, so it can rise faster in the short run than GDP. And if you look at historical evidence, this increase is pretty consistent. But I will say, if that's the story, it should be going away, because most people expect growth to level off, to slow down in 2019. So we shouldn't be seeing that kind of accelerator effect going forward. So that's where I say time will tell. Also, evidence looked at by Gravel and Marples, a recent paper. There's some questions about the composition of investments. So I would say, the jury's still out. If that boost is maintained, that actually will be a pretty positive effect of the act. If it fades away, then those long run, really positive long run projections don't look very likely. And just a last point, where's the money for that investment supposed to have come from? Well, the big story was we reduce tax rates on capital in the US, we would have a lot of inflows of capital from the rest of the world. US firms would be investing here instead of abroad. Foreign firms would be investing in the US. And this is a graph of net lending as a percent of GDP, kind of the capital flows into the US on a net basis. And basically, you can't see anything so far. And to me, that's even a little bit of a surprise. I mean, I would have thought that we would see something. And it was an area that I worried about the Tax Policy Center's projections, because we did not predict a lot of capital inflows. We were at the lower end. So far, that's looking like a pretty good prediction. So,
So I'm Jeff Hoops. I'm an assistant professor at the University of North Carolina at Chapel Hill, the director of research at the Tax Center. So I mostly study the effects that taxes have on taxpayer behavior, including especially changes to tax law. So I'm going to talk about today two different papers that I'm a co-author on. The first is entitled Tax Reform Made Me Do It. This is co-authored with Michelle Hanlon and Joel Slemrod. And this essentially looks at the immediate effects of tax reform. So in the paper, we focus especially on the kind of the first quarter after tax reform. And we find a whole bunch of different things. We find really no effect on special dividends. We find no effect on dividend initiations. We find no effect on increases in dividends the quarter following tax reform. What we did find the quarter following tax reform, we didn't actually find a substantial change in share purchases. But since then, we've updated kind of our analysis to find that we do see kind of a substantial increase in share purchases in the 4 quarters following tax reform. So this graph depicts the actual dollar magnitude of share purchases from 2010 to 2018, so a full year after tax reform. And of course, this is the type of evidence that we've seen in the media that people on the left, for example, get say this is tax reform is all benefiting the wealthy. On the right, people say this is explicit evidence that tax reform is working. These companies have all this money that they're saving, and so they're giving it back to shareholders as they should. What I would like to point out is a little bit more nuanced than one might think. So, for example, in the paper, we graph not only the actual dollars spent or dollars sent back to shareholders by way of share purchases, but if you just look at the actual number of firms doing share purchases, it remains flat. So this is not a story about more firms actually doing share purchases. It's the existing firms doing way more share purchases. The second thing is, in any kind of analysis, you have to think, are we actually going to attribute this to tax reform itself? Well, people knew, or at least had a sense that tax reform might be coming. You might expect companies to have behaved differently actually before tax reform and to alter their behavior before tax reform. So this is, this is not the type of evidence you would have in an academic paper, but if you just eliminated the 2 years before tax reform, this is the graph you get. And you don't actually see much of an effect. It looks like we basically continued on with the trend that was happening from 2010 to 2015, 2016 and 17 seemed very abnormal in that we had low share purchases, and then 2018 continued the existing trend. The last thing that we talk about in the paper is that even if you do decide, yes, we did see an increase in share purchases, this graph right here, the red line is total share purchases. The blue line is share purchases from all companies that repurchase shares except for the very largest share purchaser. So we take out in every single quarter one single firm. And for the first 3 quarters after tax reform, it's kind of startling like how much of an effect one single firm, in this case all 3 quarters were Apple, had on the graph. Right? So certainly share purchases changed after tax reform, but it was very concentrated in essentially one single firm. We do many other things in this paper. One thing that we do, and where the title comes from, Tax Reform Made Me Do It, is we talk about what companies actually said about tax reform, right? So this was early 2018 when we were writing the paper, and so there wasn't a lot of evidence on what they were actually doing, other than immediate things like share purchases and dividends, but they were talking about it a lot. So we looked at the kind of earnings announcements and quarterly reports of firms to see what they were saying. Found a lot of evidence that a lot of firms said they were going to invest. I guess the jury's kind of still out in whether the long term they actually will invest. We did see some kind of short run investment increases. One thing following tax reform that was very interesting that a lot of people probably noticed is a lot of companies were issuing what we call tax reform bonuses. So they're saying, tax reform is a great thing. We're going to pay our employees more. We're going to increase our minimum wage in our firm. We're going to actually increase, give a one-time bonus. We're going to increase the pension amount that we're giving to employees. So there are all these kinds of benefits that firms were announcing for their employees. So in the paper, we document hundreds of these benefits. But the question is what was kind of the motivation, right? So again, this is a political act. So you had actors on both political sides of the aisle. And on the left said, there's not that many firms doing it. The amounts aren't very large. And this is all just kind of like marketing for tax reform. You have these corporations that push for tax reform. And so they're trying to make tax reform look good. And on the other side, you say, well, if tax reform really did save these corporations money, they were at some kind of competitive disadvantage, and some of the savings of tax reform may well be expected to go to employees, and we would expect to see the companies that save the most be most likely to do this. So in the paper, we actually explicitly look at that, and we find kind of 2 things kind of supporting both kind of conjectures, and that we find it is true that companies with Republican-leaning political action committees were more likely to issue these tax reform bonuses. But it was also the companies that had the largest decreases in tax rates following tax reform. So it does seem that there was some economic motivation. It was the companies that were kind of saving more, that were passing some of those savings on to their employees, but it was also companies that might have favored the Republican-led tax reform. So the next paper I'd like to talk about kind of real briefly is it's called Making Only America Great, the non-US market reactions to US tax reform. So it turns out on December 22nd, 2017, the day that tax reform passed, I was in Mexico. And so I saw this news headline first in Spanish as I was in Mexico. And so it made me think it turns out in the United States, we deal with the rest of the world deals with us. It would be interesting to look at how other markets besides just the US has responded. So this is a relatively simple paper in that we take the kind of key dates that there was a news about tax reform. So this is a graph of Google Trends for the term tax reform. And you say that it was really concentrated on just a couple dates, right? So there are 6 kind of key dates at which all associated with some kind of legislation on which the market really learned about both the probability of tax reform happening and then what was actually going to be in that bill. And so we do a lot of things in this paper. I just want to kind of depict one, is we say, well, there's been many academic papers already established that this was good for American firms. This shouldn't startle us. We're going to decrease the corporate tax rate. It was kind of the biggest piece of this. Stock market prices for US firms should go up, and indeed they did. So this is a graph that depicts that. So this blue line is for US firms, and we see a pretty good increase on day 0, which is that day kind of lined up an event time of the day that tax reform, this news about tax reform happened. What we do is split out kind of the rest of the world, and we see the red dashed line is the rest of the world, which was basically 0, which kind of surprised us at first. We thought maybe this was making US firms more competitive, and in the short run, this is a zero-sum game, then maybe foreign firms would have suffered a little bit as US firms increased. That didn't seem to be the case. At least they had 0 returns. But if you split out, essentially take China, so that's the gray line is foreign, removing China, We do see a positive effect of tax reform on the share prices of foreign firms. And then if you look explicitly just at Chinese firms, the yellow line on the bottom, we see a pretty negative effect. So in the paper we looked at, there's certainly alternative explanations, steel tariffs and these types of things. We rule those out in the paper. We also look at like the way this affected industry would also be consistent with tax reform having some kind of effect on the competitive landscape in the US. So those are kind of the two kind of preliminary pieces of research that I've been a part of that tell us something about what actually happened as a result of tax reform.
Thanks, Jeff. My name is Dan Lynch. I'm an assistant professor at the University of Wisconsin-Madison in accounting. My research interests are corporate tax avoidance, tax policy, and then financial reporting issues related to taxation. So as Jeff alluded to, one of the big changes with the TCJA is the drop in the corporate tax rate from 35% down to 21%. And what that drop in the tax rate did was it provided an incentive for firms to try and increase their tax deductions in 2017 when the corporate tax rate was 35%. Because for every dollar of tax deduction, you're going to get a 35% haircut in 2017 versus if that tax deduction occurs in 2018, it's only going to be 21%. So my co-authors and I decided to look at one specific tax deduction, specifically the defined benefit pension contribution. So my co-author is Fabio Gertner, who's an associate professor at the University of Wisconsin-Madison, and then Mary Vernon, a PhD student also at Wisconsin, and I decided to look at what are the effects of the TCJA on defined benefit pension contributions in 2017. So you get a tax deduction for your defined benefit pension contribution. So you have to actually pay this pension contribution. And one of the really nice things about pension contributions are that in your financial statements, in your annual report, you're required to disclose your expected pension contribution for the following year. So for 2017 pension contributions, the firm would have had to disclose when they had their 10K or annual report released in February or March, what they expect to put in 2017. So as Jeff kind of put some of the key dates up there, and we all know, tax reform was kind of rushed through, let's say, and it was far from certain in February or March of 2017 whether tax reform was going to pass. So we can kind of look at the difference between what firms actually put into their defined benefit pension contribution versus what they said they were going to put in. So that's one of the nice things about our paper, and try and figure out, what did tax reform do in terms of defined benefit pension contributions. So this is one of my graphs up here where I've got our sample of firms. We're all calendar year taxpayers. The bottom dotted line here is the expected pension contribution over time. And then the top line is the actual pension contribution. So we can see in 2017 this market increase in this divergence between what they said they were going to put in versus what they actually put in. So when we throw this in a multivariate regression model, control for a number of things, use some firm fixed effects, we find that indeed firms are increasing their defined benefit pension contributions in 2017 by about 25% to 30%. And then within our sample of firms, about $6 to $8 billion in unexpected pension contributions. So over and above what they said they were going to go in. So pretty economically significant amount is going in here. We then do some cross-sectional tests within this study. So if it really is due to the reduction in the corporate tax rate, we would expect firms that pay taxes to actually change their contribution behavior. So we cut on whether the firm has positive taxable income or not, and we find that tax-paying firms are the ones indeed more likely to contribute in 2017. We then look at a financial reporting incentive. So I haven't mentioned this yet, but firms can actually deduct on their 2017 tax return pension contributions made up until September 15th of 2018. So they have this ability to make the contribution later and still get the 2017 35% tax rate on that deduction. So it kind of begs the question, well, why would you not wait until 2018? Why do it in 2017? These are all actual contributions in 2017 I'm showing here. So it turns out that pensions, defined benefit pensions, are one of the big drivers of what are known as deferred tax assets. So your pension expense for financial reporting purposes is usually much higher than your actual pension contribution for the year. And you can only take the tax deduction on what you actually contribute. So that difference between the financial reporting or GAAP pension expense and the actual cash contribution creates what's known as a book tax difference. And that book tax difference has to be valued at the enacted tax rate. So prior to TCJA, it would have been valued at 35%. Well, now there's a new enacted tax rate. And really importantly, this enacted tax rate was signed by the president before the end of 2017. Okay? So this requires the revaluation of all of these book tax differences. So what we did was we looked at firms that have high pension-related deferred tax assets or high net deferred tax assets to see, are those the firms that are making these contributions actually in the calendar year 2017? And that's indeed what we find here. So I've got 4 lines behind me right now. We're cutting on both whether you are a taxpayer, positive taxable income, or not having positive taxable income, and then whether you have a high pension DTA or not. And these lines are the unexpected pension contributions here, so that difference. And as you can see, the tax-paying firms with the high pension DTAs are the ones making the biggest pension contributions in 2017. So I think in summary, our study makes a couple of contributions. We document an economically significant increase in these defined benefit pension contributions in 2017, kind of an anticipatory effect of tax reform, right? Trying to increase your tax deductions when there's a higher tax rate. And then I think we also document this financial reporting incentive related to trying to avoid these deferred tax asset write-downs. Importantly, when you write down a deferred tax asset, you're writing down an asset, and that means you're actually decreasing your net income. So that's where the financial reporting incentive comes into play here. Trying to avoid that write-down seems to be an important part of the story here. Thank you.
All right, thank you. It's actually quite a bit to unpack in a short amount of time, so let's see. We've heard about investors' initial reaction to tax reform becoming law. We heard about what firms said they were going to do in terms of their announcements about how they plan to respond. We heard evidence of some, how they actually did change their behavior in terms of their pension contributions. And then kind of the macro, like what did they do on a broader scale, or so it appears. So it does fit together in a way that we can now hopefully delve into a little deeper. So I'll start back kind of with the big picture. Ben, and in your opening comments, you mentioned a recent paper by Grayville and Marples. And in that paper, they found that investments did grow significantly, 2018, but not in a way that's consistent with the incentive effects you'd expect from the tax changes. So I'd love to hear your thoughts on that, if you agree with that, kind of what is it that makes that their assessment? And also, how can we know if any positive economic effects are directly the result of tax reform as a general matter?
So that paper kind of takes a clever tack at trying to answer that last question. So kind of looks at, well, if this rise in investment was due to the incentive effects of the TCJA, what are some finer grained implications of that you might expect? And that's kind of a test of exactly that question. So what the paper found is that if you look at different types, broad types of investment, structures, equipment, and R&D, that the changes in incentives were actually different for those different categories. And in fact, the biggest incentives were for investment in structures. The least incentives and actually disincentives were for investment in R&D. But then if you look at how investment actually changed, investment in structures, which had the biggest increase in incentives, actually increased the least. Whereas investment in R&D, which the theory would say should have gone down, actually went up quite a bit. So I think this is like it's a clever test, and it is an additional piece of evidence that, well, maybe this increase in investment that we saw isn't due to TCJA. It might not persist. I think the proof really is in the pudding, though. It's what happens to investment as we go forward, because it's going to be harder and harder to explain the increase in investment, the longer it's maintained. I think you know, the Keynesian effects, the accelerator effects are a pretty good explanation so far, but that's not going to continue to be true. So I think it's a good piece of evidence, but it's still, you know, we still have to wait and see how things will develop.
Okay, and that thinking of how firms respond to these incentives and increasing in investments, Jeff, one of your papers looked at what firms said they were going to do, announcements about increases in investment or employee benefits. And first off, is it unusual for firms to attribute their actions to tax reform so explicitly in that way? Have we seen this before in the past?
Yeah, so it is not that uncommon. I would say that it was much more common this time than in past. So for example, I have a paper that looked at the dividend tax rate increase, both the planned dividend tax rate increase in 2010 and the actual dividend tax rate increase in 2012. In that case, you saw a few firms talking about tax reform as a reason why they were, for example, issuing special dividends or shifting special dividends, but a lot of firms that clearly did something that was tax motivated that did not actually attribute to a change in tax law. So in our Tax Reform Made Me Do It paper, we also look at this, and we find that the majority of firms that are issuing these share purchases, for example, do attribute it to tax reform, but not all. I mean, you can see some that are clearly doing more share purchases than they've done in the past, or that are issuing a special dividend, or that are initiating a dividend that don't necessarily attribute it to tax reform. So to me, it's a very interesting question to which I don't have an answer. What is the driving force? Like, what's the conversation that happens in the boardroom as you craft this kind of disclosure? Why would you want to attribute the effect of tax reform? I also wanted to add something to the last question. I think it's kind of a very important question. How can we actually attribute effects to tax reform? So as I was listening to Dan talk, he showed this kind of amazing graph. You know, pension contributions went up, and I thought, well, that, you know, I'm convinced, right? Clearly, tax reform caused this change. And yet he kept on going, and we did this test and this test and this test and this test. It's actually kind of a very high bar to attribute something causally to tax reform. And so it's a challenge, especially as an academic research, when you hear, you know, in the press, you know, everybody wants to blame tax reform or attribute everything to tax reform, whereas knowing if tax reform was actually the cause is much more difficult than one would think. And then kind of the more important, an important piece to that is that, you know, it's important to know what the short-term effects of tax reform are, but what's incredibly important is to know what the longer-term effects are, right? So we passed this bill hoping that it's going to, those who passed it hoping that it's going to improve the United States' economic situation in 2030, 2040, 2050. The challenge with that is the further away you get from the bill, the more other things have happened, and at some point it becomes kind of impossible to attribute anything to tax reform. So, you know, we pass a bill to have long-term effects, and to some extent, it's almost impossible to actually know if those long-term effects happened, which is kind of a broad challenge in the policy arena generally.
Unfortunate for the tax researcher, but I guess that's one good thing about the short window that you had between introduction and enactment of this bill. A lot of people bemoaned that, but you were probably very excited to hear
Yeah,
it.
so that's what I would call identification by immediacy. Like if something happens today and you see a big effect tomorrow, it's probably the thing that happened today. But it's harder to attribute if something happens in like 10 years.
All right. Dan, let's talk about pensions for a minute. Your paper suggests that firms have an incentive to accelerate pension contributions into the 2017 tax year when the tax rate's higher, because obviously the tax benefit would be greater. But what makes pensions special, and what other types of tax deductions might have seen the same sort of incentive effect potentially?
Yeah, so I think it's relatively easy to increase your pension contribution. So we talked to some pension actuaries and kind of asked them, you know, is it kind of set in stone what you're going to put in? And they said, no, it's pretty easy to actually increase a pension contribution. Contrast that with something like depreciation. If you're going to take depreciation on an asset, you know, you have to place that asset into service. So you actually have to, you know, do that. So it's more difficult to accelerate other types of expenses where you actually have to either place something in service or actually incur the expense. So I think pensions are a nice setting to examine really the idea of accelerating tax deductions into 2017 as an anticipatory effect of tax reform.
And just to tie the two papers together, wouldn't bonuses also be something that there would have been an advantage to move bonuses into?
Yep, and that would be generally pretty easy to do as well, because you can, make sure you accrue this bonus and pay it within a certain time period, and you'll get the tax deduction for that. So yeah, I think that would be an interesting study to see too. Is there shifting of compensation, right, around the TCJA? Just talking about Jeff's point, the challenge with tax reform is multiple things are changing at the same time. So how can you attribute it to a certain firm? In our study, we're kind of lucky in a way that we're looking at 2017 before a lot of the changes are actually occurring. But in 2018, where we're actually trying to nail down, did this cause this? You kind of got to be clever in trying to figure out, what firm wasn't affected or not affected as much, right? To come up with your control group to compare, your treatment group to. And I think there's a lot of really smart people in this room and academics around the world that will figure that out and be able to, shed light on probably what is the biggest tax reform since 1986 for sure.
Well, you mentioned how firms are affected. Jeff's paper talked about not just U.S. firms, but foreign firms and equity prices right after passage of tax reform. To start us out, help us better understand how U.S. tax changes could affect, Jeff, foreign equity prices. Like, how did the U.S. tax law change potentially affect a foreign firm?
Yeah, so there could be many different effects. So first of all, a large foreign firm very well might have operations in the United States. So if you're a German firm, for example, and if you have a U.S. subsidiary, all earnings earned in the U.S. by that U.S. subsidiary will face the new lower tax rate. So that's going to be a good thing. If you are a German firm competing against a U.S. firm, you now have, in Germany, you have a U.S. firm that now might have more cash available to it, right? So it's not going to have to pay as much tax in the United States, especially the taxation of the international earnings on the earnings in Germany has changed. And so there might be kind of this competitive change. So the challenge on our paper is we can look at the stock market reaction, but we don't know if, for example, it's just these firms have a U.S. presence, therefore it was good for them. If they're competing against U.S. firms and therefore tax reform might have been bad for them. So that's kind of two of the effects that tax reform might have had on foreign firms.
Well, I think we all know that tax reform was a massive piece of legislation. Speaking to practitioners, it seems they're still grappling with how to implement it. And so given that, how is it that investors could anticipate the effects of reform on foreign or U.S. companies such that they could price it in immediately upon passage, which is really what you've measured is this price effect?
That's a very good question. I mean, so I think the answer is that tax reform, parts of tax reform were very, very complicated, and parts aren't even established law yet, right? We're waiting for the Treasury to issue regulations on several different aspects, and for sure, taxpayers will respond, and then the courts will decide exactly what the law means over time. But I think kind of the headline change just from 35, the tax rate went from 35 to 21% is likely most of what we're capturing. And that was relatively straightforward for most of the discussion. We thought we were going to go from 35% to 20%, and kind of in the middle of the process, it changed it from 21%. But I think a lot of the effect is just the tax rate dropping. So I think there are a lot of nuances, a lot of things we still don't understand, a lot of things that have had over the last year and a half have been kind of complicated to understand, but the market seems to be very good at picking up kind of the simpler aspects of tax reform. So there's actually an academic paper that was published in the early 2000s that looked at the 1986 tax reform and looked at equity analysts, and it basically took many different kind of changes in the tax law and says, here's the simplest changes, here's the most complex changes, like what do analysts actually understand? And it basically finds that like somewhere in the middle, when things get complicated enough, analysts just fail to understand. My guess would be something similar would be in this case. The more kind of nuanced parts that probably aren't even established law yet, the market may not have appreciated those, but the factor that's probably driving most of the cash flows anyway is just the tax rate. The market is probably picking that up.
Well, that kind of relates to a question, Ben, I have for you. Jeff's paper actually describes the factors affecting the calculation of a firm's cost of capital, including the tax rate, of course, present value of depreciation deductions, tax treatment of interest expense, and tax treatment of net operating losses. Tax reform changed all those things, some in a big way. So how hard is it to estimate the effect of reform on a firm's cost of capital?
So full disclosure, I wasn't the one who did the cost of capital calculations. My colleague Joe Rosenberg did. So it wasn't difficult for me, is the good answer. I have talked to Joe about it, though, and he was able to put most of those disparate provisions you talk about into our usual framework of analyzing the cost of capital. Some of them were trickier than others. One that we were not able to incorporate was the limitation on net operating loss deduction, because the framework kind of is analyzing the break-even investment for a firm that's facing taxes. So you don't have this kind of a risk of going in and out of taxable status, of having earnings and then not having earnings. So because that didn't really fit in the framework, that was not included in our cost of capital, but the rest of the provisions were.
All right. I want to return to pensions, Dan. Your paper focuses on two main incentives to accelerate these pension contributions: tax benefits of deductions, where we have higher rates, again, which is something that is nice to talk about now, since it is easier to calculate and measure than cost of capital, but also the financial reporting benefits associated with avoiding a deferred tax asset write-down. Is there any way, were you able to capture in any way which of these two effects is really dominant? Like, what factors influence the relative importance of financial reporting benefits versus real cash tax savings?
Yeah. I think it's difficult because the rate drop kind of creates both incentives, right? So by the rate going from 35 to 21%, there's the tax savings incentive, but also the fact that this is the new enacted tax rate where we got to value the book tax difference or the deferred tax asset. They're kind of working in unison with each other. I would say that our results, though, that the high pension DTAs or high net DTA firms are the ones making the biggest contributions in calendar year 2017, suggests that the financial reporting incentive is in play here. How much? I think that's difficult to tease out. Some other tests that we do in the paper, though, is we look at the financial reporting pressure that a firm faces. So in these tests, we just look at really analyst fouling. So presumably you have higher analyst fouling, you worry a little bit more about your net income, you have higher financial reporting pressure. And we do find some evidence that the firms with the high DTA, with the higher analyst fouling, are the ones making greater pension contributions in 2017. So I think the financial reporting incentive is there. How much is driving the effect versus the tax incentive? I think it's difficult to tease out at this time.
All right, well, in your paper, you find that they fund these additional contributions with internal sources of cash instead of issuing equity or debt. So that makes me think about another big provision in the Reform Act, which was the deemed repatriation of previously untaxed earnings inside foreign subs. So this cash is going to be taxed either way, so why not bring it home and do stuff with it? And so a lot of people are looking at, what was that stuff? And Jeff's paper will turn to and talk about like share repurchases maybe being one thing they did with all this new freed cash.
Yeah.
Did you find any possible reason to believe that some of that freed cash was being used to fund these additional contributions?
Yeah, we really did not. And I think just stepping back, it makes sense to me that, a firm's not going to issue debt or equity to fund a pension contribution. Given that tax reform was enacted kind of late in the year, it's probably hard to plan in order to make that contribution. So our main finding is that, firms with higher internal free cash flow are the ones making the biggest pension contribution. In terms of the multinational test that we did in the paper, we did some pretty simple cuts at this time. We looked at foreign versus domestic firms that, using a proxy for potential benefits of that trapped cash coming home, which I won't get into. We didn't find any evidence that those firms are making greater pension contributions in 2017. Now, that's not to say that in 2018, those firms aren't making greater pension contributions, because we got to remember that you can still get that tax deduction in 2017 if you make it up until September 15th. So I think there's more work to be done in that area as well. And just in general, right? I think a big potato or big question is, what are firms doing with this foreign cash that's now, deemed repatriated and they have access to now? I think that's an important research question that we're going to all have to tackle.
Well, just to follow up a little bit more on the idea of the additional contributions, your paper highlights the fact, I think we're all have heard and are aware of the fact that we have systematic underfunded pension plans. Is your effect that you're finding all temporary? Is it just shifting from one year to the next? Was there any permanent increase such that the unfunded status has been improved to some extent?
Yeah, so the 2018 pension contributions, you might be wondering, like, what's happening in 2018 with these pension contributions? The data really just came out for these calendar year taxpayers, and we've looked at it, and it does seem that firms that made really large unexpected pension contributions in 2017, they're definitely not keeping that level in 2018 and maybe going even lower. Now, other firms, though, that didn't make the large 2017 pension contribution, they are making greater pension contributions in 2018. So maybe they weren't the ones subject to the financial reporting pressure, or they chose to wait. I think the jury is out on whether this is a permanent increase in the funded status. I think we'll have to wait until 2019, really, to see what happens with these with the funding of these pensions. Now, I don't want to kind of belittle the fact that if these pension contributions are accelerated 1 year faster, those plan assets are in the defined benefit pension, and they're actually earning returns for the people that are benefiting from those pensions. So, I mean, those can be significant given the magnitudes we're talking about. I think future research will kind of tell us, was this a temporary acceleration, or did we at least see some type of increase in the overall funded status of the plans?
I think we'd be remiss to not spend some time talking about share repurchases, given how much it was in the news. Some were obviously dismayed at the increase in repurchases following reform. Jeff, your paper highlights a CNN headline that said tax cut scorecard, workers 6 billion, shareholders 171 billion. That seemed to be the message that we saw in the papers. Is that an unfair portrayal of how firms shared basically the repatriated cash between workers and shareholders, or what should we make of the increase in share repurchases post-reform?
Yeah, so it's a complicated and kind of nuanced question, and the exact question you ask, is that a fair portrayal? I'm not really sure what fair means. So like in the accountant's dictionary, fair doesn't factor as a word. Likewise in the economist's dictionary. But if you start a corporation, I mean, a corporation is just a group of people who put together money to invest in some project that alone they couldn't do that. So shareholders have kind of a legal right to the assets in a corporation. So it should not surprise one that if corporations and their managements at corporations and the shareholders who they're representing decide what to do with assets, that they don't give those assets away to somebody else. Right? So as we talked about a few questions ago, we asked the question, like, is there something special about pensions? And then a response was that they could have also paid bonuses. Well, if you put money into a pension, that stays in the firm, that eventually is going to go to employees, but that's to meet an obligation that was already legally fixed. Whereas a bonus, if it's a bonus that you weren't otherwise going to pay, shareholders are getting poorer as a result of that, right? The same thing with share purchases, right? If you pay employees more, certainly you might have happier employees, they might be more productive, that might increase firm value kind of indirectly, but in the end, you're still giving the money away. So it shouldn't surprise us that corporations and the people who make decisions for those corporations are going to want to keep the money for themselves. And I don't think that that's either surprising or kind of wrong in any way. I mean, what it really means is you have this cash coming into the corporation because you're repatriating it from abroad because it's not subject to the kind of the lockout effect of our old international tax system. You also have this lower rate. What it means is these companies essentially didn't have something to invest in, and that they're returning those funds back to shareholders. Now, what many of these articles, like the one you talked about, kind of don't discuss is that shareholders who receive these repurchases, they don't like burn the money. They don't hide it under their mattress. They're going to do something with it. So they're likely going to invest it in other kind of more profitable investments. And so it's going to end up helping the economy, that cash isn't lost just because it goes to shareholders. So I mean, the alternative view would be, employees are actually there creating value for the firm. They should get some of the benefit of tax reform. And there are a lot of people that are sympathetic to that view, but just legally, employees didn't ever have a claim on those assets. Shareholders did, and it shouldn't surprise us that they don't want to just give the money away.
So why didn't we see an increase in dividends given all that?
So that's a very good question. I think it's very related to kind of Dan's point when you ask, like, what's special about pensions? I think with kind of any tax reform related thing or any tax change, it's important you can kind of categorize the responses in different categories. Ones are just like timing effects, where you're going to shift things that would have otherwise happened. You're going to accelerate them, so that would be like the pensions example. Some things, though, you're going to do one time, and it's not going to create kind of any obligation for you to do in the future. So if I do a share repurchase, either under an existing plan or under a new plan, I can do that once, and that doesn't necessarily create any obligation for me to repurchase more shares in the future. I mean, it very well may be that the election flips who's in the White House in 2020. We could get a different kind of players on the court, and we might get rid of tax reform. The rate could go up. You don't want to initiate a dividend and have the obligation to be paying a dividend with a now higher corporate tax rate. So I think kind of the short answer is dividends are a permanent thing. Companies are very, very hesitant to decrease a dividend, and so they don't want to increase something that based on a tax cut that they're not sure is permanent.
All right, makes sense. Well, I'm going to turn to some audience questions after one more question for Ben, because this one is I think, probably on a lot of people's minds. Governments usually enact tax breaks like full expensing during recession to encourage investment, and individual tax cuts can be a means to encourage spending. The Tax Reform Act was not acted during a recession. We were at near full employment. How does that timing, the timing of TCJA's passage in kind of this atypical setting, affect the potential economic outcomes?
So I'm not sure it affects it as much as some people argue. So the really big difference in economic conditions for the effectiveness of fiscal policy, short-run fiscal policy, is when we're really deep in a recession, so deep that the Federal Reserve has interest rates at zero, and they're not going to respond to changes in fiscal policy. And so we did have those conditions during the Great Recession, and under those conditions, cuts in taxes or increases in government spending do have especially larger effects than they do when the Fed is free to respond to changes in fiscal policy. And in general, if they have their policy setting rates with the anticipation of a certain output and growth rate, and fiscal policy does something to raise that, they're going to offset it with increases in interest rates, even if it's not cutting interest rates as much as they would have in a recession. So that's the really big difference. So if you look at specifics, I think it's not quite so clear. So something like expensing. You pass expensing in the middle of a recession. Are firms really going to respond to that? Are they really going to add to their capacity at a time when the economy is doing poorly and there's no prospect of selling the extra production? So I think for expensing, that might actually be more effective when times are good. In terms of consumer spending, I think you can see both sides. On the one hand, when times are good, people might be more likely to buy big ticket items like cars, washing machines, I don't know, with their tax cut. So that would tend to argue that the effects on consumer spending would be greater when times were good. On the other hand, if someone's unemployed, if their wages have been cut, they might be especially likely to spend all of their tax cut, which would argue that responses might be bigger in a recession. So on that side, I'm not quite as sure.
Okay. Well, I want to turn to the audience now and see if there are any questions from you that you'd like to share with the group. Yes. Yes, there's one coming your way, I believe.
Thanks. Reuven Avion, University of Michigan. Just one comment for Jeff on the dividend versus repurchase point. So this is a trend that has been going on for a long time, long before tax reform, that there are more, in fact, 6 times as much, I believe, share repurchases than dividends. And that's, on the face of it, puzzling since 2003. We've equalized the capital gains rate and the dividends rate. So why is that? And I think the answer has nothing to do with tax reform. The answer is the fact that a lot of equities are held by hedge funds in the Caymans. And if you're a foreigner in the Caymans, the dividend is subject to 30% withholding, and capital gains are tax exempt. right? Because, and in a public firm, which is what we're talking about, you can always structure a repurchase to be capital gain and not a dividend under the law. So I think that's part of what's happening, is that you don't see dividends, not just because of signaling and permanence, but simply because a lot of equities are held by hedge funds in the Caymans.
Thank you. Yes.
Steve Rosenthal, Tax Policy Center. Kevin Hassett, the current chair, soon to be former chair of the CEA, predicted $4,000 a year salary increases for workers. Surprisingly large. The CEA wrote a report, said there were two channels that would lead to this increase. One channel was, as Ben highlighted, increased capital investments, increased productivity, later salary increases to reflect increased productivity. We haven't seen much of the first step, so the jury's still out on that channel. But the other channel that I found fascinating was when Kevin Hassett suggested the direct channel, that corporations would just become more generous when they had big corporate tax cuts. Have we seen any sign of corporate generosity apart from this timing shift of pensions and bonuses that paid in 2018 and deducted in 2017? Any corporate generosity to the workers?
Yeah, so that's a very interesting question. I would say that we have not seen magnitudes along $4,000 on average per worker. I don't know whether long-term the first channel will create that. I'm skeptical it will, but kind of the jury is still out on that. We have seen, I mean, in my paper, like I mentioned, some of these corporations did issue one-time bonuses, but many actually increased, for example, the minimum wage at the corporation. I was actually talking to a corporate tax director last night, actually, interestingly, that at her corporation, they made this change. They actually increased the minimum wage from 15%. She told kind of a story of people at the company she knew personally that had been well below the new minimum wage. The wage was jumped up, and this made like a substantial impact on their lives. Now, certainly that wasn't very many firms, but we did see some firms take action, and I don't know whether it was something particular about the firm, whether it was something that kind of the board of directors, the CEO, some personal belief that they held that compelled them to this. We do see some stories of increased generosity. I would say on average across firms, though, we haven't seen a huge kind of impact.
And I guess I would just reiterate your comment from before that you, as an economist, you wouldn't really expect it. Like that's kind of giving, when you're just looking at the bottom line, that's giving money away. And you know, you can even think that it would be a violation of, you know, guarding your shareholders' interests to be giving that money away. So on the one hand, you know, that would make you not expect it. I do think that sometimes, you know, there are human relations in employment relationships that go beyond the bottom line, and, you know, thoughts of fairness and workforce morale. And so I don't think it's outside the bounds of possibility, but the bottom line is you wouldn't expect that to happen very much.
I mean, I think these relationships are important. So we had kind of, for this paper, we had the entire list of like everybody who'd ever announced this, and we only looked at the public firms. We basically just discarded private firms because we didn't have enough information on them to include in our paper. But there were hundreds and hundreds of firms, you know, like small insurance companies or banks that had like between 5 and 50 employees that did this, and I expect it's probably kind of this interpersonal relationship where you're the CEO, you know all of these people, you're happy to pass some of that savings on, and it's not the response to like some rational economic calculation that you're going to share, it's just that that's a personal decision you've made. But I think that kind of there are limits to how that relationship-based decision can happen kind of the larger the corporation gets.
All right, and I saw a hand back here first.
So I actually had a question for Jeff related to your paper and the share repurchases. So you talked about, obviously, these funds don't go up into the ether and how they're being spent, and that says a lot about, you know, what is actually being done and what that actually does for the economy overall. So I think it would be curious to look at potentially peer firms, or if I was trying to rebalance my portfolio, what's happening with somebody that if I was trying to maintain the same kind of investment, but that firm is saying, I don't have those investment opportunities. How would I rebalance versus some other type of firm that really has no relation to it, and those that benefited from those extra funds going back to investors? So I just think that could be interesting, whether it's somebody that it has a similar beta, but potentially more Tobin's Q or more value in some way. So just might be something interesting to look at.
I think that would be very, very interesting. I mean, certainly the data would be difficult to get there, but to understand kind of the economic effects of share repurchase, I think that would be very useful. Now, we do have some evidence that, we had a kind of a tax discount on repatriating funds in 2004 and 5 with the tax holiday, dividend repatriation tax holiday that happened then. There is some academic evidence that in kind of zip codes just surrounding, like very micro level analysis, just surrounding areas of firms that repatriated money and likely sent it back to shareholders, was probably the biggest use of those funds, that there were, for example, increases in employment. So that is a little bit, has something to do with how individuals are actually using these funds, but we don't have a whole lot of evidence on that yet.
Susan Clifford, representing the corporate tax officer community. I second a lot of the discussions around tax deduction planning on the heels of US GAAP deferred or revenue recognition. We did a lot of things around accounting method changes and things of that nature. I think one of the surprising things that came about in 2018 is we were looking at our projections, forecasts of cash taxes for 18 centered around state income taxes. Many of the states were coming out with how were they going to handle GILTI and things of that nature. And we found that actually our state tax payments were going to be increasing significantly. I'm from Illinois. Illinois announced almost $1 billion more in revenue collections for 2018 tax returns than they were expecting, about 7% increase in corporate tax payments. And so I would challenge this group to think about what is going to be the effect on state revenues as the states begin to decide how they're really going to handle tax reform itself.
Yeah, I think that's a really interesting question. Bring up a good point. These different states have to decide, are we going to honor immediate expensing, right? Or are we going to decouple from that? Are we going to have the GILTI or BEAT provisions in there? So in addition to that, I think the corporate rate drop from 35% down to 21% and the change to this quasi-territorial system makes the benefits of state tax planning a lot more salient to companies, right? So I think there's going to be an increased investment in state tax planning, and I think it's a really fruitful area for future research. Like, what makes a state decouple? Like, what is the main driving factor here? I think that'll be really interesting to see. I think that I was at the same dinner last night talking to the tax director, and she said that getting involved with state tax policy has been her life this year because of all these decisions at the state level, whether to follow the federal provisions or not.
All right. Thank you. Yes.
Austin Nicholas from Apt Associates. It's primarily a question for Jeff. You talked about these Google Trends results, and I'm just curious, we were promised a border adjustment tax and that it was taken away from us, and I'm just wondering what the sort of theoretical effects of that would be, and then also what the empirical effects are.
Sorry, I didn't hear you. The theoretical
Border adjustment tax was part of the proposal and then not part of it.
Yeah, so the theoretical effects, yeah, so it's a very good question. So we had, back in 2016, we were kind of debating adding a kind of a very new, very different thing that hasn't been, at least in the precise way that was proposed, a part of kind of any tax policy, right? And the theory would suggest that we were going to impose these taxes on imports, we were going to give these tax deductions for exports, and that somehow this was going to neutralize currency, prices were going to change, and this wouldn't actually hurt importers. So that's what the theory would suggested. The importers, for some reason, didn't believe the theory. They spent massive amounts of advertising dollars trying to fight this thing. They were very successful, and it didn't end up happening. So I actually have an academic paper that looks at the stock market reactions surrounding the kind of key points in the discussion about the border adjustment tax, and found that indeed the firms that would be importing the most were kind of the stock market expected them to be hurt. So again, we have kind of the academic theory and the academics who have these models that say like nothing's going to happen. Both the firms themselves and the stock market both didn't believe the theory, I guess. And the challenge is we'd never enact it, and so we won't ever know. So maybe if we could get Congress to run that experiment for us, we'd actually know the truth. But that's that.
Yes.
Hi, Jane Gravel from the Congressional Research Service. So in the study of worker bonuses, I remember reading an article I thought was very interesting that you might look into, which they identified some of the firms that announced these big bonuses, well, big in a relative term, that announced bonuses. And they argued that many of them were for firms that were heavily regulated by the federal government, like banking industry and so forth, and you mentioned insurance and banking yourself, or firms that had mergers before, coming up, so that they were really just kind of sucking up to the federal government with these announcements. Is there any way in your data that you could look at industry composition or whatever to see whether there's a pattern like that or whether this was just a few firms?
So we didn't see, as I recall, that big of differences across industries. Certainly, the analysis that we ran looking at Republican-led political action committees is along these lines of whether or not this was just done to kind of placate the government to make tax reform look good. And again, we find some evidence of that. We also find that the firms that had the largest tax decreases did indeed pay the largest bonuses. And I think it is interesting how kind of the messaging shifts. You said these big bonuses, and then you kind of hesitated and said not that big. Certainly, this was like a political point, right? So if you're an associate at Walmart, you could qualify for anywhere for a $500, $1,000, $1,500 bonus. What's fascinating to me is the politicians who talked about this. To them, $1,500 isn't very much. To a Walmart employee, that's quite a bit. In a macroeconomic model, per employee, that might not be a ton. So it's interesting just how the messaging surrounded the size of those bonuses was and how it really kind of divided how people think about money and quantities of money. And I thought it was fascinating.
And just to kind of on the lines of the cynical thought, you said that, Republican-led PACs lead to bonuses and the biggest tax breaks lead to bonuses. I'm wondering about the cross correlation of Republican-led PACs and tax savings, which it wouldn't surprise me at all if those were correlated.
Yeah, certainly. So we considered that. The challenge is there just weren't, kind of the sample size didn't allow us to go into that fine. I think what was actually interesting is, I talked with several different kind of news outlets about this result, and they wrote it up in very different ways. And one that kind of surprised me how they wrote it up is kind of actually back to Steve's question is, you could certainly phrase this as Republicans wanted to make tax reform look good, but just as legitimately, you could rephrase it as Republicans are the most generous with the proceeds from tax reform, right? These companies were the ones passing this on, and it shouldn't surprise us that if you kind of believe in something, you campaign for that to be a thing, you actually think that that's going to be best for probably your firm and the economy, that you're more likely to be generous with the proceeds from that. So even the empirical evidence that we have, you can interpret it in kind of very different ways and get yourself in very, to confirm whatever political bias you have, you can take that coefficient and confirm it.
Interesting. Yes, Kira.
Question for Ben. Your first slide showing the expected change in GDP, both in the short term and the long term, you said it was a wide range, but it's really only a wide range because there was one outlier on the right, which I think was the tax foundation for the long-term change. Most of the change, it was a very big difference between their short term and their long term. Why was their number so different than everybody else on the slide?
So I should say, for convenience, I didn't put in the numbers from the Penn Wharton budget model because they didn't have a single 2018 number. So they had for the 2027, their high estimate was 1%. So there was something up towards that. But as I said, the real, what produced the range was kind of the difference between the incentive effects on investment and the crowding out effects. And the tax foundation projected large incentive effects, but basically the big difference was they projected no effects of crowding out. So basically these funds would flow in from overseas or generated domestically, and so whatever demand there was for investment, firms could find the funds. And that's what really, I think, creates that big coefficient. I mean, I look at think of things in quantities. And so I think about, well, there's a deficit that's going to take, you're selling bonds, that takes up a certain amount of savings. And so it just doesn't make sense to me that deficits wouldn't crowd out investment. But, we've run an experiment over the past 10 years or so. And in a recession, I think that goes by the boards, but now we're up at full employment, and we should be seeing the crowding out. We should be seeing effects on interest rates. We should have seen, I would have thought, we should have seen effects on interest rates from the passage of the tax bill. Instead, long-range interest rates are kind of low relative to short run. So, that's one at some point you have to start to rethink your priors, I guess. But I still think that certainly I think that the tax foundation assumption is an extreme one, that there's going to be no effective deficits.
Okay, we're actually on time at this point, and so I want to thank our panelists. I think that was a really interesting conversation about a lot of broad topics, and I know I learned a lot, so thank you, all of you. We are going to now go to a short break. I think we have a 15-minute break, and then we'll resume again back here with our second panel to talk about more effects of TCJA. All right, thank you very much. Thank you. Very nice.
Well, thank you all for attending and staying. The first panel was great, and I'm hoping we have a great second panel as well. I'm really pleased by our panelists. We have two of the top, if not top, academics who've been writing on the Tax Cuts and Jobs Act, both before and after its enactment. Reuven Aviona from Michigan, who's written a lot on international tax questions, and Lily Batchelder from NYU, who's written a lot on domestic questions. And so truly a couple of the leading scholars. And then we have a couple of the leading practitioners, which was really cool. Jeff Madru from Baker McKinsey and Nancy Millett from Deloitte. And so we're expecting them to give us like what's happening in the trenches. And so I'm hoping that this panel will be more interactive. I've tried to coax my panelists to ask each other follow-up questions and not just rely upon me, make my effort a little easier. And the plan here is to start with Reuven giving us an overview of what the Tax Cuts and Jobs Act had in it from an international perspective and what Congress was trying to do. And then Lily to give the same kind of talk or overview, brief overview on the domestic side. And then we'll turn to our practitioners to find out like, well, what's actually been happening, and that will kick off our conversation. So with that, Reuven, can you tell us on the international side, what did the Tax Cuts and Jobs Act provide?
Thanks, Steve, and thanks, Eric, and everybody for inviting me. It's a real pleasure to be here. So in a way, it's strange to start with international because normally, international is, an appendix to the domestic, but maybe not in this case. I mean, first of all, somebody mentioned this is the biggest tax reform since 1986, and international, this is the biggest tax reform since 1962. So it's really meaningful. Second of all, at least my sense, and all of you are Washington denizens, you may know better, but my sense is that the international was kind of driving it. So you had all the multinationals saying we have to have territoriality. Then all the domestic companies were saying, well, if you're going to do that, let's cut the rate because otherwise it's not fair to us. And then all the pastors saying, well, if you cut the rate for corporations, then we have to cut the rate, and so on and so forth. It's kind of so there were 5 elements in international tax reform, and I just mentioned them briefly and say a little bit about something about them and how they relate to each other, and then I will let the rest of the panel engage with them more specifically. So the first one we've heard about already. This is the transition tax, one-time tax on the close to $3 trillion accumulated earnings overseas. That's basically what paid for everything. I mean, if you look at international, it was more or less revenue neutral, except for the transition tax. And the transition tax is what paid for all the rest of tax reform.
Well, why do we need, by the way, why do we need a transition tax?
Well,
what is that?
we need the transition tax fundamentally, I think, politically, because for budget reconciliation, you need to keep tax reform within $1.5 trillion over 10 years. But also, when you're looking at multinationals, according to their financials, sitting on close to $3 trillion of income that was not taxed anywhere by and large, because that's the reason it was trapped, then it's too tempting a target for politicians. And what's really interesting, of course, is that the rate that they settled up with in the end is higher than what Obama was proposing. And this is a Republican Congress with a Republican president, but that's where the money comes from. But that's kind of in the past. Second element, of course, the famous territoriality, which, as somebody already called it more correctly, really a participation exemption. And in my mind, that's the most surprising element in tax reform, because that's, as I said, was driving the whole thing. But in the end, it is my impression, and the practitioners will probably have more to say about this, that not a lot of American multinationals can actually benefit from the participation exemption as enacted, because it is only limited to a return of 10%, deemed return of 10% over tangible assets. And most large American multinationals don't have a lot of tangible assets offshore as of now. Now, they may acquire them in the future, or they may move, tangible assets offshore in order to benefit from it, but most of the big ones don't really benefit from territoriality so much. And that's really surprising because that's what was driving the whole thing. So instead, what we have are the two other kind of twins, GILTI and FDII. So GILTI is essentially a minimum tax imposed on foreign earnings above the QBI plus 10% that I just mentioned, the deemed return on tangibles. And it's set at a rate that is half the domestic rate, so 10.5, but with foreign tax credit, it can be as high as 13.125. And it applies worldwide with cross-crediting, and we can talk more about that, but that's essentially the idea is if the foreign rate is too low, then it kicks in for these. And for most multinationals, that's most of their return that is subject to GILTI, so that's obviously a very big deal. But then the concern was, well, if we're going to tax offshore at 10.5 and domestically at 21, there'll be more incentive to shift. And so we have FDII, and FDII has the same structure, that's why I call it the twin. The first tangibles plus 10% gets taxed at the full rate of 21, but if you're an exporter and you have returns above that, then you get 13.125, which is supposed to be the same as the GILTI rate with foreign tax credits, so less incentive to shift, and we'll talk in a moment more about whether that works. But that was the idea. And then we have the BEAT. The BEAT is a minimum tax on outbound payments, and it's a 10% tax on an alternative base, so you add in interest and royalties and some other kinds of payments that are paid to foreign-related parties, and you calculate either 21 on the normal base, like the old AMT, or 10% on the new base, and whichever is the higher, that's what you pay. So the combination of the GILTI and the BEAT is essentially what the OECD now calls the GLOBE, a global base erosion tax. So the idea is for the GILTI, if the source country doesn't tax, the resident country should tax, and for the BEAT, if the residence country doesn't tax, then the source country should tax, in this case, the United States, except that the BEAT, unfortunately, doesn't, or that's the way it's designed, doesn't take into account whether the residence country actually taxes or not, which is a major issue, and I'm sure we'll hear about that because that gives rise to the potential of double taxation. And that's basically a very short description of the international provisions.
Okay, so to summarize, very, very short, the U.S. previously had a worldwide system of taxation. Our multinationals were taxed on income, in theory, wherever it was earned. But we exempted deferred offshore earnings until they were repatriated. We shifted to something that was labeled a territorial system, but has elements of a worldwide system with a minimum tax on foreign income, but its principal thrust at taxing U.S. income. The transition issue was just to make sure those offshore profits that never were taxed. And then going forward, we have a whole bunch of funny acronym anti-abuse rules that are phenomenally complicated and fascinating. But with that, let's shift. What happened on the domestic side, Lily?
A lot happened on the domestic side, so I'm going to focus maybe on 2/4 elements. So the big news was, of course, that the corporate rate was cut from 35% to 21%, and the bill created a new deduction for pass-through business income that was unlike anything that we'd seen in the tax code before. The pass-through deduction is called 199 Cap A, and it's a 20% deduction for qualified business income. People aren't eligible if they're employees. You aren't eligible if you're a C corporation paying the corporate income tax. And if you have income above $315,000 if you are married and $157,000 if you are single, there's some further restrictions. So you can't then be a service business and claim it. And the deduction is limited to some sort of formulaic percentage of either W-2 wages paid by the business or their W-2 wages paid plus their original basis and their assets. These constraints on higher income owners of pass-throughs are not particularly binding. So JCT, maybe a month or two, put out some slides estimating that 92% of Schedule C, E, and F income qualifies for the pass-through deduction. So most pass-through income is going to be eligible for this deduction. So just to give a sense of how this changed incentives, because this panel is about how businesses have been responding in their tax planning. Before the TCJA, this just is showing the highest marginal tax rate on different types of income. And before the TCJA, there was an incentive to convert from a C corporation to a pass-through if the investor needed to receive the income or use it relatively soon or was planning on selling the stock. Then they could cut their top marginal tax rate by about 6.7 percentage points. And in case this is confusing to people, I am including the net investment income tax in SECO, which is why the numbers may not be as you would initially expect. But then if they were going to delay taking distributions for a long time, they would have an incentive to be a C corporation. And so partially as a result of this, because a lot of times people are going to sell their stock or want to take distributions, we had a relatively large share of our business income was in the pass-through sector relative to other countries. And then also, if we go back prior to the TCJA, there was very little incentive, if any, to convert labor income into pass-through business income. There were some ways you could avoid the net investment income tax or SECO, which are 3.8% if you're high income, but that was the main reason to do so. So if we then go to post-TCJA, it has created a big tangle of incentives in these areas. Now, if you're a business owner and you want to access that cash relatively quickly, there's about the same incentive to be a pass-through over a C Corp. It's now 6.4 percentage points instead of 6.7. But there is a much bigger incentive to be a C Corp if you're able to defer indefinitely or for a long time taking distributions or selling your stock. And now, for the first time, there is a really huge incentive to convert labor income into business income that ranges from 7.4 to 19.8 percentage points. So in terms of the response, I wanted to focus on two things. One is entity choice, and one is employment relationships. On entity choice, among pre-existing businesses, my anecdotal impression is that they're very confused about what to do with all of this. Some are responding by becoming C Corps if they can afford to defer taking distributions or selling stock. But they're worried that the 21% rate is not going to stick around forever, especially if Democrats retake control of Congress and the White House. Some, maybe fewer, are converting to pass-throughs. And they're worried that 199 Cap A is going to expire as it is scheduled. They're also worried, interestingly, about penalties. So I hadn't realized this recently, but the penalty regime was changed in the TCJA. So we have something called accuracy-related penalties, where if you misclaim your taxes by more than 10%, you owe a 20% tax on your misstatement. And the TCJA changed that threshold for substantial understatement to 5% if you claim 199 Cap A at all. And that applies to the whole return. So apparently some businesses that have been thinking, oh, maybe I'll try to take advantage of 199 Cap A and either maybe restructure as a pass-through, maybe try to rearrange their business to jump through the hoops to get it, then talk to their accountant or lawyer and say, oh, if I'm going to be subject to this huge possible substantial understatement penalty, if I do so, just forget it all. So the other interesting area is employment relationships. As I mentioned, employees are ineligible for 199 Cap A, so at first blush, this creates an incentive to be an independent contractor. And even if you're high income, there are a lot of service jobs where you still qualify. So for example, real estate brokers still qualify for 199 Cap A, even though it excludes brokerage services, which I find a little perplexing, but we'll set that aside. So you can cut your taxes by almost 20% if you claim the pass-through deduction on your labor income by characterizing it as pass-through business income. And you can cut your tax liability by about 50% if you are wealthy enough to be able to not take distributions and recharacterize your labor income as C Corp income. There are a lot of downsides, of course, to being an independent contractor that we can go into maybe in the discussion. But one thing to note is that this incentive is much smaller for low and middle income households. So it's really high income people that can argue that they are not kicked out by being in a services business. They have this really big incentive to recharacterize as a pass-through or a C Corp. The other two things I'll just mention really quickly are, one was expensing, which was talked about on the last panel. The bill did extend expensing through 2026. It sort of phases down gradually over time, and this is a big provision in the bill, and runs in the opposite direction from prior tax reform proposals where, for example, my former boss, Chairman Baucus, former Chairman Camp, and President Obama had all proposed slowing down depreciation as part of tax reform, and instead this bill sped it up, at least temporarily. And another one is interest deductions. So historically, we've allowed interest deductions, deductions for interest payments, but not dividend payments. And then even though we tax interest income at a higher rate than dividend income, that has created on net an incentive to finance with debt. And so I think one of the positive aspects of the bill is that it does limit interest deductibility. That limitation effectively phases in over time because the way it is calculated becomes much tighter starting in 2022. And so my anecdotal impression is it's not having a huge effect. It's not terribly binding yet, but if that 2022 new way of calculating went into effect, it might have a lot more juice.
So Lily, what was Congress trying to achieve with expensing? Why go in a different direction? And what was Congress trying to achieve with the 20% pass-through deduction? What's the goal here?
So I think the expensing provision sort of rested on a theory that people on both sides of the aisle, some believe, which was that you'll get more investment if you move towards expensing because it creates an incentive for investment. I think almost all tax experts would agree that if you do have expensing, you should totally repeal interest deductions. And this bill through, I think it was 2022, has 100% expensing, and it only has a small limit on interest deductions. So I think the rationale was to try to improve economic performance. I've written some on, there are other people that are a little dubious of these claims, and I've been a little dubious of them, in part for some of the accounting reasons that were raised on the last panel. Expensing is a deferral benefit. So the whole benefit of expensing is that you get to deduct the cost of your investment sooner than it's actually declining in value. And when you have deferral benefits in tax, they are real money. They're worth a lot to a company. But on your financial statements, they don't matter at all. Because financial statements basically ignore the present value of tax benefits. They don't take present values. And so if companies are really concerned about their book income and not as concerned about, what I would think of as their real economic income, then they don't really respond to expensing. And there's a fair amount of evidence suggesting that that's the case.
So the last time we tried something like this, I think was in 81, where we had something like similar to expensing and unlimited interest deduction, and that really exploded the deficit, so it was reversed in 82. But that hasn't happened this year.
Hasn't been reversed yet. We're about to get to practitioners who are going to tell us what they're seeing, but I just wanted to finish with just the last pass-through.
Yeah.
Why a pass-through deduction?
Yeah, so this was something that I saw back when I was on the Hill, a lot of pressure about this. And the concern was if you really cut the corporate rate, then that's unfair to pass-throughs, because shouldn't they get a rate cut too? And the individual top rate was cut, but not nearly from 35 to 21%. So I think if one was to try to develop a coherent theory for the pass-through deduction, which I'm not a big fan of, it would be that it's trying to create parity between pass-throughs and C Corps. And if we look at this chart again, it's trying to make sure that that pass-through line of 39.8 is somewhere between those two corporate ones, rather than at one end or the other. The problem is that it's really easy to recharacterize labor income as pass-through business income. And so what the bill did was at least nominally say, we're going to give you a deduction for pass-through business income, effectively cutting the rate, but we're going to kick you out if we think that you're converting labor income into pass-through business income. I don't know many people that think that the bill has done that at all effectively. So what it's really done is create a giant sheltering opportunity for high-income people to convert their labor income to pass-through business income, which they were already doing through the NIT and SECA loopholes, which were part of the ACA, and the SECA one dates even way farther back. And the NIT one, the net investment income tax, was estimated to have a very small revenue effect. And it has now blown up to cost $250 billion over 10 years with the SECA loopholes. So that sort of demonstrates that high-income people really do respond to these incentives.
Okay, well, that's our overview of the international and domestic. So Jeff, Reuven told us that we had the international tax rules restructured fairly considerably. I think most people agreed the old system had these oddball results of allowing multinationals to accumulate untaxed $3 trillion of earnings offshore. And redesigning our international tax regime was the driver, I think Reuven is correct, of this tax bill. What have you seen in practice? Like, are companies responding? Are they restructuring their businesses? Do they even understand what's going on?
Thanks, Steve. Yeah, they have a pretty good understanding of what's going on. They're trying to react to big law changes that are really only being defined now by regulatory guidance that's still coming out, with a whole lot of guidance to come out before June 22nd this year. So there's a lot that's in flux with the rules. One major driver of international tax reform really is the rate difference. So the US rate used to be at 35%, which made us a tremendous outlier in the world. The average for OECD countries is all in the low 20s. So that alone really put lots and lots of pressure on US-based companies to continue to stay in the US. And indeed, since the rate was reduced and since reform was enacted, we haven't seen any US companies do so-called tax inversions, where they essentially expatriate from the US and become a foreign-parented multinational. And that's something to celebrate, I think, because Congress has been trying to stop inversions since 1983, since the first one was done. And every time they've tried, there's been a new wave after tax practitioners have figured things out, basically, and worked around the rules. And I think they're kind of done for now. So that's been a big change, I think something that's been effective. For the offshore cash, it wasn't completely untaxed, right? A lot of non-US countries have been eager to tax those profits, but it's been at a low rate of tax, much lower than the US. And it's built up over time. Why was the buildup there? Because you could book the benefits of your offshore earnings immediately for GAAP purposes, right, and report it to the street. But historically, you didn't have to pay US tax until you actually brought the cash home. And to Lily's point earlier, cash tax doesn't matter very much to the people that I advise. It's all what you report to the street. So getting that benefit was huge and created a very big lockout effect that made the cash sit offshore and stay offshore. Since this change, where now all of your offshore income is subject to current tax, essentially at a reduced rate, and the transition tax taxed all of your offshore earnings, also at a reduced rate, as Reuven noted, has freed up that cash. But interestingly enough, it doesn't move as quickly as you might think, or as people might hope. You don't move $2+ trillion with a complex set of new rules on a dime. So the earlier panel, we had a lot of discussion about share repurchases, and I found that very interesting, and perhaps not a little surprising to me that the repurchases had not increased as much as one might have predicted, or as quickly, because companies are figuring out, well, when and how can they actually bring the cash back without tax? If there's one phrase that applies, I think, for all tax law, one sort of common bromide that works is that the devil is in the details, right? The devil is in the details. God is never in the details. It's always the devil is in the details of tax. And we have now a new regime, but just to illustrate, the rules to figure out when you can bring back cash tax-free rely on something called previously taxed income or previously taxed earnings. We used to have essentially 2 buckets of previously taxed earnings, and now we have 16. It's a very, very complicated set of rules. It's very easy to run afoul of it. One other illustration for you to think about. I have young kids at home. They like to make toast a lot. My son Ethan will often have the toast get stuck in the toaster, and I'll have to remind Ethan, please don't use your fork to get the toast out. Or if you do, please unplug the toaster first. And that's really the way the international tax rules are like. So if the companies that have moved back cash very, very quickly, a few of them are really struggling now to figure out, oh, actually, did all that cash come back tax-free, or do we have some leakage that we didn't anticipate? So as we see more guidance come out, there will be more certainty, and people will be able to respond appropriately, but it's taken longer than one would hope.
So that's a transition issue. Actually, it's interesting. A lot of the so-called offshore earnings were invested in U.S. treasuries and U.S. financial institutions, and this was just a booking issue, that earnings were booked and retained offshore, and so in foreign affiliates. I would have thought it was a simple matter to rebook them to the U.S. parent, which could use the funds in its enterprise, but you're suggesting the rebooking is a lot more tricky because of tax law complexity.
It is, yeah, it is.
Well, and it's not all in cash.
Yep.
That's the thing is the headlines would be, this is in a piggy bank in a bunch of countries that have a low tax rate. It's not in a piggy bank. People have oftentimes, when they've left the money offshore, what they've done with it is they've invested. That's how they've grown their business outside the U.S. So even with the transition tax, there were multiple rates because you had to figure out what was really not here, what was in a piggy bank offshore, what had been invested. And in the transition tax, you go through all the complicated tax rules to figure out what you'd made that you said was offshore. But then when you went and brought it back, it was at different rates based on whether it is in a bank account, it is invested in property, or exactly where it sits. And so it sounds really easy, but the devil is in the details, because people have had to go back years and years to figure out what they really made in the other jurisdictions, what they already brought back and paid tax on, to figure out what's really still there. And it's taken a lot of time just to get transition tax figured out.
Was there a lot of planning around what foreign earnings were in illiquid assets and subject to a reduced, I think it was an 8% rate, versus liquid assets and subject to a transition tax of 15.5%? And did your clients move things from one bucket to another in anticipation?
I wouldn't say it was a planning opportunity. It was figuring it out back at the end. Because the effective date that you had to look at for some of these measurements was not the date that President Trump signed the bill or the date that it passed. It goes back to a date that it was first introduced. So you can't plan when you find out, when something gets done in the morning, and the afternoon you find out it's like too late. So the planning was really not planning in terms of doing something in advance, but figuring out the interpretation of what had been done, what was in the rules, how to interpret in the rules, and it was ever evolving. Even I worked some with individual clients that they had to pay transition tax, and not only was it hard to figure out, but April 15th a year ago, that morning they announced you were going to submit your payment a different way than what they had told people up till that point in time. So they couldn't even, if they can't tell you how to send in the money, do you think they would have figured the rest of it out? No. It was too much, and it was too quick. It wasn't bad intentions really on anybody. It just all happened so fast.
Go ahead.
Oh, just one point to clarify in all this. It's not actually the case that the unrepatriated earnings were necessarily not in the U.S. So a company could have a foreign sub that then would take a bunch of cash that they have, put it in a U.S. bank account, or invested in portfolio investments in U.S. companies, and that was fine. They didn't have to pay the tax. So just want to clarify that this bringing back concept, sometimes the money often was already here. It was just in portfolio investments or savings.
But it sounds like a lot more complicated than I realized to sort out, where all these these deferred earnings actually were placed. How about restructuring? Jeff, Nancy, are you seeing clients restructure their operations, both tangible and intangible property? Reuven highlighted we have a bunch of new rules to incent, say, intangibles to move to the U.S. And I think Reuven has noted that there may yet be some incentive to shift tangible assets abroad. Are we seeing anything in the restructuring area, or are companies still trying to sort that out?
There's still a fair amount of sorting. So historically, the heavy incentive was to locate intangibles outside the U.S. because the U.S. rate was just so much higher than almost anywhere else in the world except Brazil or Japan or India, a few countries. But really, the U.S. was about the last place you'd want to own IP. And since reform, I wouldn't say that the incentives have been pushed the other way so that there's a mass race to bring intellectual property back. But I have seen a decrease in the amount of activity to create and form new IP offshore as opposed to the U.S. And some companies have brought IP back, have restructured their operations to take the foreign-owned IP ownership as defined for tax purposes and bring it into the U.S. group. Now, there are some quirks in the rules where the BEAT rules that Reuven mentioned earlier, actually, if you bring the IP back the wrong way, can punish you in a funny way. So there's some odd disincentives actually in the tax law to if you bring the IP back, you have to do it the right way. But on balance, I think the best way to put it is we're not seeing a rush to bring it back, but we're seeing less outflows, and some companies have taken advantage of it. I don't know, Nancy, what's your experience?
Yeah, I think whether it's IP or the BEAT or any of these other provisions, people are still doing a lot of studying, and I haven't seen people do wholesale changes to supply chain or other things. There's a lot of work being done to sort of figure out where they really are going to sit in the future, because it's murky in terms of what your facts really are, because all the rules aren't out. So what I have seen is people spending a lot of time being thoughtful about studying it. If they are doing acquisitions, they're doing additional modeling that they hadn't done before about where they want to put things, how they want to acquire things, which investments would be more attractive versus less in terms of a jurisdiction. The U.S. is a more attractive jurisdiction with a lower rate than it was in the past. So people are taking that into account in terms of the here and now business decisions they have to make related to current transactions.
And how about domestically? Lily highlighted the choice of entities in the U.S., corporate or pass-through. Is the jury still out on your clients on entity selection, either new ones or recharacterizing existing ones?
Yeah, I would, and I'm sure Jeff will want to jump in on this as well. I do a lot of work with corporate clients, but I do a lot of work with family-owned businesses as well. And so there's probably not a family-owned business that's in a pass-through setting that hasn't looked at whether that's the right thing for them and evaluated it for the short term and the long term based on how they're structured today, who all owns the business today, whether they need to get money out on a current basis to pay interest or whatever. Just people have studied it. And so there are a number of companies that have decided they want to go ahead and convert to a C corporation because even if the rate goes up, they still think that it's better for them for the longer term. People are taking more time to study what's the right thing in terms of new operations, whether they set it up in a pass-through or not. And these are big operating businesses. It's not a situation where it's something that could be on a W-2 or in a pass-through kind of setting. These are real operating businesses where people have plants, they have thousands of employees, things like that, but they're set up in a pass-through situation because of the tax modeling that was done. The other thing that's a twist, and somebody talked about state taxes earlier, is the state tax implications of all this are very significant. Because although you've got the 20% deduction or exclusion for federal that will bring down your federal rate, your state rate went up. And if you're in a pass-through situation, your state income tax is not deductible. So it really is a competitive disadvantage from the rate perspective to have a large business on your individual return with no state tax deduction, because even though it's state taxes related to a business, it's not deductible. So there's a real disparity that I don't know that was intentional that got it created, but it did get created.
So Reuven, you wrote a number of articles during the pendency of the international tax reform, and then started evaluating the international tax reform. You've looked at some broader trends. What did you predict? Have you been right? What surprises?
Great question. Answer, of course, I wasn't right in many cases. No, but there is some data. Jane Gravel over here has accumulated some of it recently in a CRS report. So as maybe predicted, and that was correctly predicted before, tax reform has not eliminated shifting, because when you have 21 domestically and 10.5, foreign, then you would get more shifting, but it has somewhat reduced it, which is what economists like Kim Klausing predicted and then also analyzed in retrospect and found that in fact was the case. Now, we were supposed to have a counterbalance to that in the FDII provision, and my sense, and in this Jeff and I may not agree completely, and it'll be interesting to hear from him, is that FDII has not really worked as well as people maybe thought it would, or at least not in the predicted ways, because you have to think about FDII as applying to three types of companies. One is the companies that were doing the shifting before, that is companies that had a lot of offshore income. So those companies, if they were to bring intangibles now into the US and do exporting with these intangibles, so for example, royalties are qualified for FDII, yes, then they would qualify for the lower rate. But on the other hand, if they had all of their intangibles offshore before and they now qualify for 10.5 or maybe 13.125, why should they bother to do that, especially since the tax law may change in the future? And then you have what I call it the Hotel California situation, that is you go in and then you can't go out again. Then there are companies that were doing exporting before and never had much offshore income, like Boeing, for example. They qualify for FDII and they get this very nice boondoggle, but they were not the ones that were intended to be the beneficiaries of it. And so we kind of go back to the Section 199 that was abolished by TCJA, that is encouraging domestic manufacturing for export. But one problem potentially with that is that this whole FDII provision, at least in my opinion, is a massive WTO violation. So if we ever get some other country like, the Mexicans, for example, now we're going to put 5% tariffs of them, I think any country can sue us, right, in WTO. I think they would be really tempted to sue us.
So we have a system in which foreign income of a U.S. multinational is taxed, at least under the U.S. tax rules, at a lower rate. And so we have an incentive that was added, the FDII, to induce more shifting of intangible income to the U.S. How do these counterbalancing factors net out?
So the one thing that is clear from the data, including the data that was presented in the morning, is that there has been no increase in inbound foreign direct investment into the U.S. So you don't see foreigners actually going into the U.S. with their intangibles, which I think is part of, in theory, you get the FDII rate if you do nothing in the U.S. in terms of actual manufacturing. You just put intangibles in, and you import, and then you export, and you get the lower rate. We haven't seen anything like that, even though I think 13.125 is a nice rate for some of these foreigners. And I think part of it is just the uncertainty. That is, once you get in, it's hard to get out again. Will the rate change in the future? And also, will this survive a WTO challenge, as I mentioned? So I think fundamentally the big beneficiaries of FDII are, I think, primarily existing exporters, and maybe it has had some impact on shifting, but I don't really see any convincing
Jeff, have you
data.
seen a lot of interest in shifting intangibles to the U.S.? Or by the way, a broader question for practitioners is, how much of tax is driving the world? We in the tax world think we drive everything. But the U.S. has some fantastic intellectual property protections and other things for intangibles. And so you might think that non-tax considerations would drive factors, at least at some level. But what do your clients tell you?
Yeah, a lot of thoughts playing off of that. So it is interesting that the lower rate is so low as to be a boondoggle, but sadly it doesn't actually affect behavior, even if I followed that correctly. I think I really look at what anecdotal things happen in my business, and I was asked by a Brazilian multinational that wanted to restructure and find a new parent, and they said, where should we form? We're going to do more acquisitions. We're going to roll up all these businesses, formerly Brazilian parented. Brazil has a very high rate of tax, a pretty unfriendly regime. Where should we locate? And the U.S. was on the list. The U.S. was on the list of possible parented companies for that combined group, along with the U.K., along with some other jurisdictions that you might predict. Pre-tax reform, that would have never happened. That just would have never happened. So that effect, and that I think is driven, I mean, to be fair to Reuven, that's driven, I think, as much by the U.S. headline rate reduction as it is by FDII. But FDII plays a role too. It's very, tax does affect decisions on the margins. The business drives the decisions, but tax will change things on the margins. In terms of benefits for exporters, not every company is in a position to be able to move IP offshore or to be able to migrate assets offshore. A lot of companies are in regulated industries, or a lot of our best jobs, best manufacturing industries are in industry-specific groups where the plant, property, and equipment is very much not easily moved. It may have to be in the U.S. And so, to my mind, having a benefit that brings the rate down on those industries to something that's comparable to, say, tech or other industries where things are much more mobile is a good equalizer and helps protect the really high-value jobs that we want to keep. The U.S. manufacturing base has been awfully hollowed out in the last 30 years or so, and I think without the FDII, I would fear that we'd see even more of that if we didn't have the FDII component in that equation.
And how about capital investment? Was Lilly's research predictive that offering full expensing without commensurate book changes would not matter so much?
Yeah, I think that was really interesting. So cash taxes in my world don't really drive behavior very much, and that's very consistent with what you're finding on expensing. The deductions for pension contributions that was noted on the earlier panel, that does create a rate benefit and can drive your effective tax rate. And I did see an awful lot of companies make big pension contributions in 17 and in 18. So that very much was borne out. I didn't see many companies that had offshore earnings do big pension contributions. But why is that? Well, that's because they don't have defined benefit plans, right? Those industries don't really have DBAs in place. So that wasn't a surprise either. So those are the kind of effects that I've seen mostly.
Lily, have you updated any of that research post-TCJA?
No, that's one of my plans for the summer. But one thing I would add here is, just to clarify, I don't think this research implies that we needed to have a bill that lost all this revenue and particularly did so from businesses. So the bill as a whole obviously lost $1.5 trillion. Even outside the 10-year budget window, it's a cut for businesses paid for by tax increases on individuals. And before the TCJA, we did have a very high headline rate. I think it was the highest among our competitors, or the second highest for the past several years. But if you looked at our effective rate, we were pretty average if you weighted by GDP. And so we basically had a high statutory rate, and then we had a whole bunch of deductions and deferral and other tax benefits that narrowed the tax base. And so you could imagine a reform that lowered the headline rate a lot less, but also paid for it, or more than paid for it, by provisions that wouldn't really show up as benefits on your financial statement, that might have had comparable effects without as much revenue loss.
Yeah. Another interesting thing from the data that I would love to see someone look into more closely is when you're measuring foreign direct investment into the U.S. and you're looking to the degree to which non-U.S. entities are lending to U.S. entities and counting that as an investment. There's a counterbalancing effect of the TCJA, which is to very much limit interest deductions with our new interest barrier rules that very much discourage inbound lending because you may not get the tax benefit out of it that you used to pre-TCJA. So I would predict that effect has caused, I've certainly seen clients not take on more debt from their related foreign affiliates, let's say, because they just don't get any tax savings at all out of doing it. And I would expect, Nancy, that's been your experience.
So I think when you think about the interest limits, most foreign parented companies had global treasury functions where they borrowed from the parent. And there were 163J or interest limit rules that already applied to any company that was headquartered outside the US. It applied to anybody, but where it really applied was to companies that were headquartered outside the US. So from the perspective of the new rules, the non-US headquartered companies would actually say that they feel like it's a little more balanced than it was before, because now these rules apply to everybody. Doesn't matter who you borrowed from. You've got the limits going forward. So I think people, on one side would say the field is now level, which is a good thing. What's not level, though, or what people are concerned about, is down the road when the rules change. Not to go back to it's not a phase out where it goes back to what they did before, but where the interest limit really does get constrained is there are a number of companies that are like, what's going to happen now? If they really are highly leveraged. And so when people are doing M&A and things like that, they are looking at what they think they're going to deduct down the road. For private equity firms that typically use a lot of leverage, I know they're concerned about how it's going to model out for them down the road. And then, so a lot of companies are concerned about it. And, we'll see how they plan around it. Some people would say, well, wait a minute, we'll just have companies that have more equity and they're more stable.
Well, what are you seeing? This is a fascinating point to me as a former practitioner. How are clients reacting to these large-scale rule changes? Certainly they're looking for some guidance from the government, but I'm sure they're looking to their advisors for guidance and the like. What does this mean? Larger tax budgets? Relying on opinions of counsel to move forward? Not doing anything? Are there clients that are undertaking an audit lottery, given the absence of budget for the IRS to do anything than write guidance? I mean, what's happening out there in the field?
I'll start. Yeah. So most of my clients are under continuous audit, so there is not much of a lottery except to the extent, whether something's noted by exam. And they have sophisticated exam teams. The IRS agents do a very good job, and they tend to spot issues. They know what to look for. On the individual side, I think that's very much not the case, and audit rates for high net worth individuals are down. So I would expect that's a very, very different, very different story. Tax budgets, I don't think tax budgets for most multinationals have increased much as the VP taxes would like to try and handle the new rules. There's a tremendous amount of complexity. I know this has been noted a few times, but you can't state it enough. There's a lot of complexity and a great need for a technical corrections act, right? Like after the '86 Act, not everything got done right the first time, and we had technical corrections not long thereafter. And I really look forward to, hopefully a change in the political position to where we can have something to really address some real problems. The other piece of the change is that it's just a very, very heavy computational aspect to all of the new rules, to the point where trying to predict the combined effect of all the acronyms, of the cute acronyms, GILTI, BEAT, and FDII together becomes an extremely complex exercise, which has pushed a lot of tax planning into tax modeling and tax computation. And that has absorbed a lot of the tax budgets of our clients, frankly. And
are accounting firms doing more of that work than law firms? I don't mean to put you one against the other.
I wouldn't go, lawyers do a different kind of math than accountants, so I think it's appropriately with accounting firms. And I would hazard to guess you're seeing a major uptick.
A major uptick. Because just the complexity, just the data, it's first you have to go get the data, then you have to do the modeling, and then you have to predict how the modeling will play out in the future. And so it's the biggest bucket of numbers anybody's ever had to go gather, and they're having to do that for prospective planning to figure out what to do, but they're also having to do it to get the reporting done. So reporting done for transition tax. If you think about it, this filing season is the first time that people are still dealing with the after effects of transition tax, but also having to figure out what to do with all these new rules. And there isn't guidance out on all the new rules. And you look at just the level of guidance that came out on some of the provisions last year, there was 1,000 pages for everything they did comment on.
So what do clients do
And so,
in the
yeah.
absence of guidance? Do they rely upon advisors?
So they're doing the best they can, because guess what? The return's going to be due. I don't know of a client that is taking the lottery risk. They really are trying to document, you know, what do they think is the right thing to do? What is the data that they have to do that with? And try to make good, sound conclusions, knowing that they're dealing with uncertainty. The other thing I'll add in terms of effort, because you're right, the budgets haven't necessarily gone up, is what we've seen in our practice and what we've consistently heard from clients is the level of effort just to get last year's return done is expected to be 30% higher than it was in prior years. And so there's a lot of stress on the organization to do that, and a lot of people saying the only way we can get that work done is to use more technology, you know, more computing power to get it done and to do more modeling around it.
Yes, Lily.
Yeah, so I had a question for the other panelists who are more international tax experts. I was curious what response, if any, you're seeing on profit shifting. So I was interested in the GILTI structure that with this sort of 10% deemed return that's exempt, if a company is earning, say, a 20% return, which is pretty good, that means the minimum tax is actually just 5%. And then because it doesn't apply on a per country basis, if you already have some income in a relatively high tax country, it can actually be 0 or -% to shift profits to a tax haven like Bermuda, because you'll then increase your foreign tax credits in the higher tax country. And so I'm wondering, as you're advising clients, has your advice about profit shifting or transfer pricing or trying to get profits located in tax havens shifted in response to GILTI, or is it sort of still, that's a good idea if you can do it legally?
I think that the thing that I've seen with clients and also heard from my colleagues that spend all their time in international taxes, all of the general rules of thumb that they would have looked at in the past to do planning, that you can't do anymore. And you can't, there's no real good general rule of thumb. You really do have to get out the pencil and sort of do the math, think about where the boxes are, and really do some level of modeling to even know whether your gut assumption going in is right.
Reuben.
One thing that I would say, I think, in terms of shifting and also inversions that were mentioned earlier, sometimes we run the risk of attributing things to tax reform that are not really about tax reform. So let's take a look at the inversion story. So the story is before tax reform, there was an incentive to invert because the US headline rate was 35 and there were all of these trapped earnings offshore, and you basically couldn't get them to the shareholders easily except by inverting. But the reality is, first of all, the effective rate was not usually 35. I mean, essentially, it was higher domestically and lower offshore, but the more offshore you were, the lower your rate was. And I'm not sure that has changed tremendously post-tax reform. But, you know, with inversion, I mean, yes, of course, we had 2 waves of inversions, punctuated by 2004, where we enacted 78-74, which stopped the first kind and put limits on the second kind. But the reality of the matter is that inversions during the Obama administration became harder and harder. Every time they put out a notice, they killed at least one, and sometimes more. And I'm not sure there were a lot of inversion candidates left. I mean, the main and most important fact to realize is that since 1994, shareholders are taxed on any inversion. So you're not going to see Mr. Bezos or Mr. Zuckerberg or Mr. Brin or Mr. Page pay billions of dollars in taxes by a deemed realization by inverting their companies. The other important thing to realize is that we're basically back to the 1960s in terms of the dominance of American multinationals in the worldwide scene. If you look at the top 20, you know, you're back up to almost all of them being Americans. I mean, yes, there are a few Chinese giants, that's true, but nevertheless, it's not as if it was back, you know, before
the digital age, basically, where there were a lot of competitors for American multinationals. Most big American multinationals are now monopolists earning a lot of rents, and we should be taxing them more, say all the economists, and I agree with that. So this whole business about shifting and cross-crediting and so on would be solved, and we wouldn't need FDII if we applied 21% across the board, which is what I think we should be doing.
Well, that raises my final question before we turn to audience questions. We've had some semantic issues describing the 2017 tax bill. Should we label it tax reform or just a neutral term, the Tax Cuts and Jobs Act? And I'd like to get the panelists, Ruben on the international and like Lily, especially domestic, but to weigh in. Ruben, do you think we had international tax reform that certainly was restructuring? And I guess it depends on your baseline compared to prior law, the way we taxed internationally, or a baseline of what we could have done. But would you have labeled the 2017 bill on an international side tax reform?
Oh, yeah, no, I would definitely. In my opinion, we're much better off than we were. I think, I would drop FDII, fine, but I think guilty and beat are a significant improvement. I think even, allowing the return of some earnings tax-free is not in my mind a disaster. And if you just look at the ability to plan, I don't think we're going to have a situation where American multinationals can accumulate that much money without paying tax on it. That's not just US, by the way. There's similar trends, of course, happening overseas. And it's, in a sense, one way of looking at TCJA on the international side is that we're just implementing BEPS. It's not that different from what the Europeans are doing.
That's being what the Europeans are doing.
Yeah, base erosion and profit shifting. This is essentially, it's the OECD/G20, so we were part of the effort. But a lot of what was done in TCJA was similar to what the Europeans have done. And I think the combination of both means that American multinationals are going to have to pay more tax, and in my mind, that's a good thing.
And Lily, how about on the domestic side? Would you say the tax law is better now than it was prior to the enactment of TCJA?
Well, I was just going to say, I think it depends on your definition of tax reform. So I guess I could define tax reform 3 different ways. One is a good change to the tax code. One is a big change to the tax code, and one is a structural one. And so I don't think this was a bill that was a good change to the tax code. I do think on the international side it was a structural change, and I think it was a big change, but under that definition, the Bush tax cuts would be tax reform, because they're big tax changes, even though, the making permanent a lot of the expiring provisions that was an incredibly costly bill, even though it was just date changes. So overall, I think the structural changes, that's a tough one. On the domestic side, I don't think we should have cut the corporate rate that much. I don't think we should have enacted 199 Cap A. I don't think we should have enacted opportunity zones. But there's, like 100 different provisions we could go through that we don't have time for. On the international side, I think structurally, a lot of it was good changes and really built on the Obama and Baucus and Camp proposals. I think it was good to end deferral, but I think the amount of revenue raised was way too low, and the way that new structure was structured was faulty. So I think we should have a per country minimum tax and not a global one. But the general idea of eliminating deferral and immediately taxing foreign earnings in some fashion, I think, was good.
Jeff, Nancy, your perspective?
I think it qualifies as reform. It's to echo what Lily said. It's easy to pick out different provisions or things that need to be fixed to say that they come in for criticism, and there's plenty of time to do that, and we do need a technical correction. But I think, by and large, the old system wasn't sustainable. We couldn't have left the top rate so high and had such a great incentive for deferral, and that's been largely addressed. I think it's been successful on that front.
Yeah, I would agree that the international provisions are reform. The others, I don't think are reform. And some of them that are permanent are really little tweaks. And then there's so many that are temporary that we'll see where we end up.
Okay, well, let's see if there are any audience questions for our panelists. Yes, Jane?
So while I got these experts here, I want to ask them a question, a related question. First is, in the House and Senate bill, there was a worldwide allocation of interest provision that mysteriously disappeared in conference. And does anybody know why that happened or how that happened? And do you think it was a mistake to do so? And the related question, because it's related to interest, is as I read the pages of international tax notes, which I do all the time, it seems to me that BEAT is the provision that people seem to see most flawed in a variety of ways. That it didn't really reach the abuses. For example, you could have allowed a deduction for the cost of goods sold at cost, but not the margin, just like you do with sales. If you'd had this worldwide allocation, you could have gotten rid of the interest payment. The way the cost of goods does allows you to fold royalties into the cost. And why not make it an add-on tax confined to the amounts instead of this sort of minimum tax that includes guilty but doesn't have a foreign tax credit? So is that your impression? Do you think BEAT's a good provision as it stands, or do you think it's flawed? And what do you think about the worldwide allocation?
So two questions. The worldwide
Lots
allocation.
of questions in there.
Anyone know about what happened there?
I mean, I'm guessing, but this is just a guess because, you know, worldwide allocation is something that was, that constantly gets enacted with a delayed effective date. In my opinion, worldwide allocation is the correct answer, but I think they just figured out it was too expensive. They had a hard $1.5 trillion, you know, window in which to put everything, and they couldn't afford it. Now, on the BEAT, opinions vary. I, on balance, think that it's a big improvement. Having any kind of outbound, I mean inbound provision is a big improvement because we never cared about inbound. We only cared about taxing American multinationals. And, you know, I think there's a lot of scope. Now, the precise details of it, you know, you can argue. The basic problem, I think, with including cost of goods sold, for example, would be, which, I mean, in theory, you should cover anything that's deductible, including cost of goods sold, but then you really run into foreign tax credit issues. That is double taxation if you do that, and the whole idea of the BEAT was to have a relatively simple alternative. I think, personally, I think it's an improvement. I think it could be made significantly better, and hopefully it will be.
And so the BEAT, generally, the base erosion anti-abuse rule, was there to prevent U.S. companies from stripping more of their income from the U.S. and shifting it abroad by making payments to, say, related parties, whether it's interest or service. And there's some exemptions for cost of goods sold and the like. But I take it you have to have something like that in a new bill if you're going to lower the tax rate on for U.S. multinationals on foreign income.
I think the BEAT was mostly, like Lily said, about foreign companies stripping earnings out of the U.S. Because U.S. companies, I mean, you have guilty for U.S. companies, so I think you can deal with the U.S. companies. The fundamental problem of corporate taxation is the fact that kind of by definition, we can only tax American multinationals on a worldwide basis and not foreign multinationals. And the distinction between an American and foreign multinational is not that big. That's what causes the inversion problem. And you could say that it's an irrational world, and maybe we'll get to a world at some point where there is no residence-based taxation of corporations, which is, I think, the correct answer, but it's not an easy thing to achieve.
Yeah. I think the BEAT has a couple challenges and I completely agree. Well, I agree with most of Ruben's points and yours as well. For me, the most problematic aspects of the BEAT are one, the unintended disallowance of foreign tax credits that can kick in, which really, if you happen to be, it can hit taxpayers who are paying high taxes offshore. And are they really the base erosion that we want to get at if you're actually, you know, making deductible payments to Germany? That's probably not what ought to be in the crosshairs. The other design flaw in it that I think I see is a cliff effect. Cliff effects are never great in tax. They make your tax advisors, you know, stay up all night and worry. And there's a 3% threshold in BEAT that, boy, if you fall over that, your effective rate can spike awfully quickly. And that is one area where defensively, to avoid tripping over that threshold, we have seen a fair amount of restructuring of expensive restructuring of real operations just to fit within this tax provision.
Eric? Eric, oh.
Hi, Eric Toder, Tax Policy Center. When you're talking about multinational corporations, they're paying taxes not just to the United States, but to other companies throughout the world in which they operate. After 1986, when we cut the corporate tax rate to 34%, we were actually a low tax rate country, but then everyone else followed us and then went below us. Now we've cut the corporate rate, we've introduced GILTI, we've made all kinds of changes. Things are going on in the rest of the world with digital services taxes and the like. So I'm just wondering how companies are thinking about these developments that are taking place in other countries and how that might affect the story you're talking about today.
I think that is, and we didn't really point it out, we focus so much on U.S. tax, but that's the other thing that has created a lot of hesitation with people, at least in my client base that I've seen, because they're trying to figure out the U.S. They can figure out what might be a good strategy in the U.S., but there's the digital tax, there's Brexit, there's all sorts of things going on around the globe, and so they're a little worried that if they whack them all over here, and then 6 months from now you have the new rule over here, that they may have disadvantaged themselves. So I think there's a lot more study going on, and people are going at a much slower pace to really implement change because of all those things and uncertainties around it.
It's a great question because the story of international tax has sort of been that U.S. rate staying as high as it is. I know we've got deductions and things, I get that. And everybody else in a slow motion race to the bottom. The U.S. is now kind of caught up, equalized. That has put a pressure on tax collections and revenues. That at the same time has been coupled with a lot of mobile income in the form of tech and other IP-heavy industries that the entire world wants to tax. And what historically has been an international consensus about how to tax things in the form of taxation has completely gone by the wayside. And everybody's kind of doing one-off provisions like digital services tax. The UK has been a leader in this area too with the DPT. And it becomes very hard for multinationals then to just simply avoid paying, triple tax, double tax, as opposed to even just minimizing their overall profile. That's been a huge area of concern for our clients. And I don't know what the good answer is if you're advising and trying to take prudent positions. I guess ramp up your lobbying efforts outside the U.S. maybe would be one answer. Yeah.
So one thing just to note for people who haven't been following the OECD work as much is my understanding is that there's a lot of discussion with the OECD now of basically building regimes that are both like the GILTI and conceivably are like the BEAT. And so we had the whole BEPS process, an ongoing BEPS process, and I think one of the issues was that unlike a lot of parliamentary countries, the U.S. can be in the BEPS process and say we're going to do X, but if it requires legislative change, the Treasury negotiators really can't guarantee that the U.S. is going to do this given the state of our Congress and presidency and gridlock. But once the U.S. moved, a lot of these other countries can reach an agreement in the OECD and then pretty quickly implement it. So I think it'll be really interesting to see the extent to which they do follow the new-ish models that were developed. And then just one final point related to Jane's question. My understanding is the BEAT is a mess, but that it conceptually is important. And it's sort of a case study of what was wrong with the process of this bill, because there were 50 days from date of introduction to passage. And some of the other provisions, at least there had been draft text or previous versions. This one was totally new. And so it's not at all a surprise that it would be a mess if it was passed within 50 days. But conceptually, we really do need a way to tax inbound companies, i.e. foreign multinationals, on shifting profits out of the U.S. If we want to effectively tax U.S. multinationals on shifting profits out of the U.S. Otherwise, we create a giant inversion incentive.
Yes.
My question is for Lily. You stated that the 20% deduction for pass-throughs was to create parity of a sort between pass-throughs and corporations. But pass-through entities range from a business with lots of employees, tangible and intangible assets, all the way down to the sole proprietor. And so there are huge difference in there. And a traditional tax policy concern has been parity between the tax treatment of the earned income of an employee and the earned income of the self-employed. And then we've thrown that out in this bill. So my technical correction would be to say that if the pass-through income is earned income for purposes of the self-employment tax, you're not eligible for the 20% deduction.
So I would be happy with that technical correction, but I don't think it would nearly do the trick. So there's tons of SECA tax invasion at the high end. And so I absolutely agree that the problem with this provision is that it creates a giant incentive to recharacterize your labor income as pass-through business income and get that deduction, or even now with the super low corporate rate, to recharacterize it as C Corp income. And one other thing we didn't mention is that the bill also effectively gutted the personal holding corporation rules. So it used to be you didn't have a big incentive to put your labor income into a C Corp because the rate wasn't that much lower and you were going to pay the double tax if you took it out. Now you have a big incentive, and it used to be that there was a rule that said, well, if it, I won't go into the details, but tried to address that issue, and that's basically been effectively eliminated by the TCJA. So I would expect over time, if there aren't changes, that you're going to see a lot more people taking advantage of the opportunity both to say that if they're high income, their labor income is pass-through income, but also possibly that it's C Corp income.
What's really weird about this whole discussion is we keep hearing about pass-throughs converting to C Corp. So what's unfair about taxing those differently if you have the option to convert? If you hate the rate, incorporate. That's what people said, right?
Question in the back there.
Yeah, you referred to the Tax Cuts and Jobs Act as a neutral term. I would argue that actually there is no such thing as a Tax Cuts and Jobs Act, as many people here know who are lawyers. When Congress enacts a bill, typically it enacts a short title. For example, in 1982, the Tax Equity and Fiscal Responsibility Act, known as TEFRA. That is the legal name of the law. But so I was confused, like what this whole conference was about, and I realized that what people have been talking about is the tax provisions of the budget reconciliation law that was enacted in December of 2017. It's popularly known as the Tax Cuts and Jobs Act, but Congress could not even agree to enact the short title of such an act.
I think there was a budget scorekeeping issue, and it was just dropped because of a funny thing. But I'm not sure it matters to the substance of this discussion.
It does matter. It does matter. I'll explain why. It was stripped out of the bill, and it's an example, it's a story that illustrates the process, the highly partisan process, and the lack of thought that was put through, the lack of hearings, which we've heard from the panel that there are technical corrections are needed. Well, they're needed because there weren't even any hearings to get input when the law was passed, and that there is uncertainty in tax planning. People don't know what the law is, and people don't know how stable the law is, and one of the reasons for that is there was no effect to achieve a bipartisan...
Wrap up with a question,
there was no effect to achieve a bipartisan consensus.
I think the comment is a good one in that, unlike the Tax Reform Act of '86, which had bipartisan support, the bill enacted in December of 2017, commonly known as the Tax Cuts and Jobs Act, had only the support of one party, and so it's a lot less stable, and this panel will reconvene, I'm sure, in years to come. Next question there.
This is for the practitioners.
In Jane's recent paper, she noted an uptick in domestic R&D investment, even though the incentives didn't really change. I'm wondering if you've seen evidence of firms accelerating their R&D investment in anticipation of the amortization kicking in 2022.
Yeah, I'm not, just like I would say a little bit on the expensing side, people are going to do what they're going to do. I think we may see a little bit more acceleration when people are down to the last 6 months, that if they get it done this year versus next year, there's a little bit of that. But if there was, what I've seen with my clients is if there was something they were going to do, they're going to do it anyway. And they're going to do it in a way that makes sense for their business. And that's been true of R&D as well as capital investment in terms of the timing on it. I don't know if other people have seen the same thing.
Yeah, I think people are either waiting until it gets closer to the change, or they're hoping that maybe it won't actually come into effect, like a lot of the multi-year changes, like the 163J dropping of the DA. They're counting on that to actually not happen. Yeah.
There's another question back there.
Back on 199A, I was a little confused.
Can you identify yourself? Your former commissioner?
Rosati is my name. Yes, on 199A. I thought you said that this is on state taxes, that state taxes were not deductible against the business income. I thought, maybe I was just misread it, but I thought that on business income that the state taxes were still deductible. So, because that would change, some of those relative incentives.
Yeah, if you have, I'll jump in and you can jump in as well. So if you have a business that's a pass-through and there is a state tax that is assessed on the business, that is still deductible. If it's the individual income tax that you pay on the business income on your 1040, that's not deductible. It's subject to the $10,000 cap. Yeah.
Yes, back there.
Thank you. I'm Allison Custer, Georgetown University. There was some mention that your clients are focusing on street earnings, and I was wondering how clients are going about communicating the impact of the Act, both for financial reporting and for operational planning with the street, and are analysts even understanding kind of what the managers are saying? Like, what are they saying, and who's understanding, who's not?
You want to start?
Yeah, there was a lot of communication that I know all of my clients did when the Act passed. And they tried to, at the same time, communicate what was the one-time implementation, and then if they could accurately predict their estimate of what the implication would be over the longer term. And so people did their best efforts to do that, and even if they didn't have that as a headline thing they wanted to talk about, they knew the analysts would ask about it and knew the analysts would want that information for their future modeling. What I think has come out, and I saw an article about it actually, I don't remember which publication within the last couple of days, is the challenge with predicting what your rate is going to be going forward. And people have had a much more difficult time doing that than under the old law, just because of the complexities of the international rules. So people are still getting asked the question, but they found the future rate a little harder to predict.
Yes. Standing in the back.
Thank you. I am Jeff Ferry from the Coalition for a Prosperous America. Reuven, you mentioned the provision on tangible assets and the incentive to move tangible assets offshore. So I'm wondering if folks, I guess more the practitioners, have seen any signs of that, either companies actively considering that or even doing it. In other words, moving tangible assets from the U.S. to offshore in order to reduce some of their overseas tax liability.
I haven't, for tangible assets, I haven't seen, there is this sort of perverse incentive because the amount of deferral that you get in the new system, as you noted, as Reuven noted, keys off of the amount of tangible assets held by your foreign subsidiaries. It's still a very small number. It's only 10% of that base, and the base is measured as your tax basis, which is a depreciable amount that decreases over time. So the incentive really is not all that great to actually move physical assets offshore, and I think as a result, I haven't seen any real interest in doing so. Yep.
Yeah, I haven't either.
It may take a longer time to move a physical asset than an intangible property, so
maybe in years to come, we'll see.
What I would wonder is whether you would see American companies buying, tangible, intensive businesses offshore. Like, if Apple were to buy Foxconn and suddenly make the iPhones themselves, they would be able to have a lot of exempt offshore income.
Yeah, it impacts the way you structure those acquisitions. You have a much greater incentive to make them considered taxable for U.S. purposes, so you get that full purchase basis.
Have you seen that?
Absolutely. Oh, yeah, absolutely. It would be nearly malpractice not to try and get a taxable treatment on your acquisition if you can and you think it helps you now. Yeah.
Yeah, I haven't seen people I haven't seen anybody that said, I'm going to close a plant here and put it somewhere else. What I have seen people do is, if they're looking at global expansion, is modeling what happens if I build the facility myself instead of renting it from somebody else, because that could help in that calculation.
Or buying a facility in a taxable transaction, as Jeff and Ruben just highlighted.
Yeah,
I guess that's
but
the
it's
same
but
thing,
it's
right?
a
buy versus lease.
But it's a lease buy decision
question.
on something
Okay, I get it.
that people are already going to do.
Interesting. There's one, yes?
Kind of related to the M&A activity that you were talking about right now, I'm interested in how immediate expensing rules have affected the M&A market. So one of the big changes is that used assets are now eligible for immediate expensing. Have you seen any trends in terms of acquisitions being structured as asset deals? And then also the purchase price allocation, right? There's an incentive for the buyer to allocate greater amounts to shorter live depreciable assets to get that immediate expensing.
Yeah, it's definitely moved the needle in favor of structuring where you can as a taxable asset acquisition versus just buying stock with no inside basis step up. So that effect has definitely been pronounced. You might expect it to be even greater, but for the point made earlier on the panel, which is that timing differences that relate to timing of depreciation deduction don't generally drive your rate. And so it's a cash tax savings often, not your book savings.
Yeah, the other thing is with the rate dropping from 35 to 21, excluding the state rate, it's worth less. So there is incentive, but there's a little bit of tension going the other way.
Yes, there.
Hi, Bill Snyder from George Mason University. With Section 199 Cap A, it seems like you might have an incentive when you're looking to hire an employee versus hire a consultant. To hire an employee costs you the same price, but if you hire a consultant after 199 Cap A, you might be able to pay them 20% less or approximately 20% less. Have you seen any incentives in this? The second question, or not incentives, any action in this area happening? And the second point is you potentially also could fire an employee or release them and then rehire them as a contractor and pay them less. So is Cap 190A done anything to shift labor markets?
I think it creates the exact incentives you describe. I haven't seen any evidence yet on whether those incentives are playing out in practice. I mean, we have seen trends towards more contingent work, more independent contractors in general, and I think it's going to be hard to isolate the effects of the TCJA from sort of an overall trend that way. One of my concerns is that even though there's this now pass-through deductive incentive to structure the relationship as an independent contractor, and then maybe the company can pay the employee less because they get the deduction, in the process they're going to lose all their employee benefits. And so my concern is that whether employees will be fully realizing what they are losing in terms of employee benefits and a lot of other protections that come along with being an employee that they'll lose if they're independent contractors. So you could view 199 Cap A, I think, fairly as a large incentive to increase the contingent workforce.
All right, well, that concludes this panel. So thank you all for attending and thank our panelists. And now we'll have closing remarks by Eric Toder, our co-director of the Tax Policy Center.
Well, thank you all for coming. I just wanted to acknowledge a few people. It takes a lot of work to put on a conference like this, and so our administrative person in TPC, Ann Clevin has done a tremendous amount of work, and I think she deserves acknowledgement for helping to organize this. Also, Courtney Edwards, who was on the last panel and moderator and did the organizing on the UNC end, along with her colleagues, Jeff Hoops and Ed Maydew, and also Antoinetta McKay of UNC. So I want to thank them. On our communications team at the Urban Institute, Haley Romer, Alana Morrow, and Ivy Hunter did a tremendous amount to make this possible. And finally, I want to thank my colleagues and other colleagues in TPC, Lionel Foster, who's our communications person, and Lydia Austin, our chief of staff, who also contributed. And last but certainly not least, these were very interesting sessions for me, and I want to thank all the panelists who have really contributed a lot to our knowledge today. Thank you very much.